this is not an economy that requires a significant amount of job growth behind it.
Jobs is a challenge, as I think wage growth will be a challenge.
We're not concerned we're going to see a spike in the unemployment rate.
The labor market is softer than what might have appeared up till now.
I don't know if the market's ready for seeing a negative print.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday, it's Payrolls Wednesday. Economists are looking for payrolls growth to hit 65K as weaker than expected data is keeping a bid in bonds, and the president is setting the bar sky high for growth this year. We begin this hour bracing for a delayed jobs report following a string of weaker than expected data, from jobless claims to retail sales, and a market-moving statement from the president's economic advisor, Kevin Hassett. One shouldn't panic if you see a sequence of numbers that are lower than you're used to, setting the tone for smaller numbers in the months ahead.
And setting a tone for sudden fears that maybe the U.S. economy isn't quite as strong as people previously expected. We came into this week with this feeling that it was all sunshine and rainbows, with $650 billion of capital expenditures coming from the big hyperscalers. It was going to create nirvana of economic growth in the United States. And then suddenly, bam, we get the 1-2 punch yesterday of retail sales and delinquencies. And then all of a sudden, we have expectations for a weaker jobs report, which raises the question, are we underestimating potential weakness in this economy that could stymie some of the hopes and dreams?
Well, let's pick out one data point, the employment cost index, and I think that's an important one. So I think there are obvious supply-side factors at work, which is what Kevin Hassett is giving a nod to. We can explain away this story. The break-even rate is lower, it's contributed to that. I get all of that. But the obvious tell at the moment, to tell, I think, historically as to whether a labour market is loose or tight, our employment costs. And employment costs were softer than expected. And I think it's difficult to construct an argument that coming into this year, this labour market has been tightening instead of loosening.
And this is something that we've heard from a lot of economists, that if you want to understand exactly what the dynamic is in the labor market, take a look at how much they're paying people. And guess what? They're essentially not raising wages. And you can see that actually the jobs that are being gained are not the high quality ones that are paying people a lot of money. This is the reason why the Chris Wallers of the world are very concerned. And you've got the Fed potentially pricing in, at least according to market expectations, more rate cuts. A real question, though, of whether this is structural, whether this is cyclical, and at what point it will bleed into some of the market-moving offense that we've seen, which really has been driven by CapEx.
Well, it's driving a big move in the bond market, let's put it that way. Yields are lower once again. We're down by a basis point, 413 on 10s. New lows for the year off the back of this weaker than expected economic data. That's the bond market. In stocks, a few things to track. Schwab and the wealth management firms. The AI disruption continues. It cascades through the equity market and reaches a new place. These stocks are trying to recover following a dire day yesterday and the introduction of just a tax management tool enough to upset some of the individuals in those names.
I love that even the CEO of Altruist, which is the closely held company that came out with this algorithm to have personal planning programs, said he was really surprised by the move, but great, we welcome it. And guess what? We're raising money. I mean, look, there is a question of how much this is almost like a witch hunt, because we don't understand exactly what some of this technology is going to deliver. So sell first and examine later. And that ultimately expresses some of the rotations that we've seen with people, just a knee-jerk response to shed any risk to any disruption. Well, guess what? We're all getting disrupted. The question is how, and the question is how significantly.
In 2 hours' time, Rick Wurster, the Charles Schwab CEO and president, joining us a little bit later this morning. Look out for that conversation. Can't wait, right here on Bloomberg Surveillance. Equity futures on the S&P just about turning positive on the S&P 500, firmer by close to 0.1%. Coming up this hour, we'll catch up with Stuart, Kaiser of Citi, with stocks within 1% of all-time highs. Scott Lincicome of the Cato Institute joins us as Congress splits over President Trump's tariffs, and Steve Englander of Standard Chartered calling for a street-low negative payrolls print. We begin this hour with stocks little changed ahead of the payrolls report. Stuart Kaiser of Citi calling for an above consensus 135 and the unemployment rate to stay unchanged, writing the following: the market rotation has been powerful and prolonged, but will have space to run. Stuart joins us now for more. Stuart, good morning.
Hey, good morning.
What's going to sustain that move?
The rotation? Look, I think, honestly, the rotation's been going in the direction that most investors wanted it to be going, to be honest with you. Since probably November, people have been kind of selling large cap growth and kind of rotating into value, and particularly into cyclicals, because anticipation of the stimulus and a strong U.S. economy. So we think there's space to go there. You also have to remember that the positioning in large cap tech and growth had built up over 2 to 5 years. This is a massive positioning in the market. You're not going to sort that out in 4 to 6 weeks. So I think if the economy remains solid and people want to be in that cyclical part of the market, it can keep going. What happened last week or the week before really is it was not the direction of travel on that trade, it was the speed and bumpiness of that. And I think that speed and bumpiness kind of created a little bit of a risk shock, both to quants and to some long-short fundamental funds. And that's really what happened. It wasn't that people didn't want to be in cyclicals. They made a lot of money in cyclicals in January. It was that the trade just got a little bit too hard.
There was a big if that you used just then, if the economy remains solid. So let's get into that. Is the incoming data beginning to undermine the trade?
It depends which one you look at. Our Citi Economic Surprise Index is in very, very, very strongly positive territory. Atlanta Fed GDP is tracking kind of mid-4s, which is very solid growth. The unemployment rate's at 4.4%. To your point, retail sales was weak. You had Challenger, you had Jolts, you had claims last week. All that kind of second-tier employment data was a little soft. So I think by and large, if you believe in just like the Atlanta GDP tracking, the economy still looks pretty solid. People still want to see this tax refund data, which hopefully the IRS will release at some point. But so it's a mixed bag. But as you mentioned with what Hassett was saying, if you're trending at 50K, let's say, as break even on jobs, that data looks weak based on our historical standard, but if that's the break-even rate, then if you're printing kind of sub 100K, it's not a weakening economy necessarily.
So if you try to sort of distill fact from noise, I'm just wondering, what's the threshold to undercut some of the argument of some sort of economic recovery that's been underpinning the cyclicals, right? I mean, it isn't just rate cuts at this point. It is some sort of recovery. What kind of data would you have to get to really undercut that argument based on the fact that so far what we've gotten doesn't seem to shake it for you?
Look, I think it's the unemployment rate. If I had to boil it down to one number, honestly, if there's three things you could tell me ahead of time this year that I would like to know, would be unemployment rate, average size of the tax refunds, and OpenAI revenues. if I could know those three things in advance, I'd probably resign and just manage my own PA. But I think ultimately this boils down to the labor market. If people have jobs, the spending is going to kind of continue, and if the arms race in AI is close, if these models are kind of within, a competitive range of each other, all of that CapEx spending you talked about, you stay in that arms race.
Let's talk about the OpenAI revenues, because that's actually really interesting, especially in light of some of the disruption that we're seeing in equity valuations. I'm just wondering, how do you distill what's reality and what's potentially fear that's getting baked in? How do you value something that seems to be so undiscoverable right now, which is the potential of some of these algorithmic, large language models?
You ask AI, of course. And
I've tried. It hasn't come up with a conclusive answer. It depends which engine you look.
Look, I think that, the issue here for a lot of folks is, especially in the software space, some of these stocks are viewed as having very low and potentially zero kind of terminal values, right? And if that's the game you're playing, that is a very high-risk, game to play. And I think what you've seen recently with some of these new announcements is, hey, I thought that company might be terminally at zero 5 to 7 or 10 years from now. And now the stuff has moved so quick, it's like, what if that zero or whatever terminal value is actually 3 years away? That has a massive impact on your ability to kind of own these stocks and see them. I think the market is probably overreacting a little bit to some of these stocks being full-time zeros. Like, any given company, I can use AI and I can build my own HR software, but do I want to be an HR software company? Like, no, I'm a bank, or no, I'm an industrial. So, there is a limit here to, if the business is so bad that I could just rebuild it in a month on AI, why would I want to be that business? Like, I want to be my business and I just want to save some money there. So I think the question here are these things zeros? It's what's happening to their margins and what's happening to their long-term revenue outlook, and how do I value that? And to your point, that is so uncertain. That you either need to do it through options or through a basket of stocks, because putting all your chips behind one or two of these it's a tough game.
We were spooked 12 months ago as well. Is this a deep-seek head fake, or is this the real deal, something that constrains multiples for the year out?
It feels a little more DeepSeek-ish, for now, just given how much the market's kind of recovered in the same way. The scary part about DeepSeek was that was the shot across the bow, and then a month later, we were at all-time highs, and then a week later, we were down 10%, right? So, like, the sequencing of last year's DeepSeek event was a pretty tough one. It feels a little more DeepSeek-ish, but you're definitely seeing a change, A, in the reaction function to AI headlines, and B, like, how people want to have that risk on. They've stepped away from owning the spenders and wanting to be in the spendees, and really, I think, increasing the risk on the victims.
So certainly the CapEx numbers now are higher than they were 12 months ago, without a doubt. The enablers is where a lot of people wanted to go, the chip players. How well understood is that story now, and how well priced is it?
The question there, I think, ultimately is just like power usage and intensity in the end, right? Like in the sense, like, so let's say take Amazon, for example. If I don't like that they're spending $200 billion because I think that's too much to spend, well, I must love whoever they're giving that $200 billion to, right? Because they're overspending. The enablers and the memory stocks, the semis, et cetera. We like AI power gen, first off. That's what we like to do it. But again, that also has a tail risk to it. Because if ultimately I need slightly fewer chips or slightly less power, that thing also kind of collapses on itself. So all of these trades right now are so sort of knife edge, and I think that's why you're seeing these intense reactions to them.
Do you think deceleration in CapEx numbers starts to matter? Deceleration in growth of these CapEx numbers starts to matter this year?
I think it depends what the message is on that. If it's, hey, we did a massive upfront CapEx spending investment, and now we can enter a glide path, let's say, where CapEx is X% of my free cash flow or X% of my revenue, and we're seeing like a way to monetize that, I think that's a very positive message. If the market forces it, the way the market forced Meta to cut spending on the metaverse, X number of years ago, and so it's kind of like, how is that message? I would actually wish these companies would say, don't put a $200 billion number out. Say, we are spending X% of our revenues or X% of our net income on this for the next 3 to 5 years because we think it's a massive investment opportunity. The market, I think, got a little bit concerned that Amazon is negative free cash flow in their own forecast, not in our forecast, in their own forecast. So it's an issue here. Yeah.
I bring this up because UBS put out this note yesterday that capex growth is likely to moderate from these levels, which could improve investor perceptions of those doing the spending, but is a potential negative for some of the companies in the enabling layer. Mm-hmm. That's really the heart of the issue at the moment.
Yeah. How much do you actually get money going to NVIDIA? How much do you get money going to some of the other chip players? How much do you get money going to some of the infrastructure plays? Look, this is the reason why this is such a perilous bet. And this is the reason why you're seeing some of these massive trillion-dollar stocks trade like penny stocks, because ultimately there's so many unknowables and the scale of these unknowables are massive.
Stuart, just quickly, leadership has changed.
Yep.
That is quite obvious over the last several months. Through last year, payrolls didn't really matter at the index level, given the contribution that came from names that weren't sensitive to payrolls. Mm-hmm. As that starts to change with the shift in leadership, do we become more sensitive to the incoming data, like payrolls at 8:30?
I think we do because, to your point, last year you were in these large cap growth stocks. Now you're in a more cyclical, economically sensitive stock. So in theory, yeah, the market leadership should be more sensitive to weak economic data than it has been. And I can tell you, investor sentiment is going to be much more sensitive to this because coming into the year, we liked that cyclical play, and investors, I think, piled into it. 2 weeks into the year, we were getting questions of, is it time to monetize this? I mean, that's how sort of jumpy people are about this. See, I do think payrolls in particular, but the unemployment rate specifically, I think, is going to be much more impactful than it had been the last.
The bull case is the consensus view, and the bull case hinges on tax refunds, to your point, the economy holding up because of the monetary policy cuts we've already had from the Federal Reserve. And on top of that, the capex spend. Now, how strong is that confidence, that conviction level? Because it feels like every time we just get a bit of data that pushes back and pokes a hole in it, things start to unravel pretty quickly.
It feels like people have a lack of understanding of exactly where this economy is going. If we're depending on tax refunds and we don't understand the scope of them and we don't understand whether people are spending them and we don't understand whether that will sustain some of the retail sales that clearly were pretty weak heading into year end, well, clearly people are getting pretty jumpy right now.
Equities this morning positive by 1/10%. Stuart, it's good to see you. Thank you, sir. Stuart Kaiser of Citi. The jobs report later this morning, 8:30 Eastern Time. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Here's Yahara Arnold. Hey, Yahara.
Hey there, John. Good morning. The House set to vote today on whether to reject some of President Trump's tariff policies, starting with a resolution opposing the president's tariffs on Canada. Speaker Mike Johnson has been using legislative procedures to delay these votes, but 3 Republicans joined with Democrats in blocking his latest attempt. TSMC shares on the rise in Chinese trading. The company's January sales grew at their fastest pace in months. The chipmaker reporting a 37% rise in January revenue. That was way better than 30% revenue growth it expected for the full year. The fight for Warner Brothers Discovery is heating up again. The Wall Street Journal reporting that activist investor Ancora Holdings has amassed a stake in Warner Brothers. The size of the position currently unknown, but Ancora reportedly planning to oppose the plan to sell its assets to Netflix. Warner Brothers has remained opposed to recent offers from Paramount Skydance. And that's your Bloomberg Brief. John.
Vonnie, thank you. My apologies for that. Vonnie Quinn on our briefs this morning. Up next on the programme, pushing for tariffs.
Tariffs are very important. I'm taking in hundreds of billions of dollars in tariff money. and we're going to start paying down debt. This country has never been so strong.
That conversation up next with Scott Lincicome of the Cato Institute, live from New York City this morning. Good morning. The winning streak ends in yesterday's session. Equity futures bouncing back by about 0.1% on the S&P 500. The main event later this morning, about 2 hours away. The jobs report looking for something around 65k. We've talked about a wide range for a week now, given how delayed this is. We're looking for something between 135,000 and negative 10k, if that's helpful.
And that could be good and it could be bad, because ultimately we don't exactly know what those numbers mean. We're also getting the benchmark revisions to the quarterly household survey from last year. This is important because we found out yesterday that the momentum heading into the end of the year was less than we expected coming from retail sales. Do you get a similar read-through when it comes to some of the revisions in the labor market?
Governor Waller looking for what? Zero, zip, nada?
Yeah.
His words. It's not pretty, is it?
It's the reason why he has been so dovish and really calling for rate cuts. And ultimately, you're seeing a lot of pushback from other Fed members, in particular Lloyd Logan, in particular Beth Hammack. How much do you get consensus to cut rates in time based on what markets are expecting right now? They're bringing forward the potential for an April rate cut. It shows you where their minds are.
Bond yields coming in just a little bit. On a 10-year maturity, we're down another basis point, 413. Under surveillance this morning, pushing for tariffs.
Tariffs are very important. I'm taking in hundreds of billions of dollars in tariff money, and we're going to start paying down debt. This country has never been so strong. I just hope the Supreme Court does what's right for the country, because now, will I figure something out? But the answer is yes. But it won't be as beautiful as it is right now.
So here's the latest this morning. House lawmakers set to vote on the fate of President Donald Trump's tariffs on Canada. A trio of Republicans joining Democrats calling for the vote. Bloomberg's Tyler Kendall joins us now from Washington for more. Hey, Tyler.
Yeah, hey, John, good morning. Well, this is paving the way for lawmakers to potentially rebuke one of President Trump's signature economic policies as we head into the midterms. We are expecting a vote as early as today that would look to repeal the tariffs lobbied against Canada on an emergency basis. Just as an aside, that is, of course, interesting timing considering the escalation recently between the two countries. But this is expected to be the first in what is likely going to be a series of votes over the next few weeks and months targeting the president's tariff policies, and really marks a defeat for House Speaker Mike Johnson, who has spent the last year trying to prevent his members from taking politically fraught votes on the tariff issue. Now, as we look ahead, and not to get too much into the weeds of what happened, but last night we saw essentially 3 Republicans cross party lines and block Speaker Johnson's attempts to block these votes. And it's interesting because if you look at the 3 Republicans that ultimately sided with Democrats, they represent different factions of the Republican Party. You have Thomas Massie, who has openly feuded with the president, Kevin Kiley, who is facing a very tough re-election campaign in a swing district in California, and then Don Bacon, who is ultimately retiring. Now, a similar effort has already passed the Senate. If this passes the House, it likely isn't going to make its way into law because President Trump would have to sign it, and it takes 2/3 of majority of Congress in both chambers to override any veto. But still, it could heap pressure on this White House in a campaign year when the economy is the top issue. John, we know the White House has been lobbying on Capitol Hill against this measure. The USTR Jamison Greer was on the Hill in recent days talking to lawmakers about it, and the administration had asked in particular for this vote to be delayed until at least June. That's when the Supreme Court term is up, and we are expecting a ruling on the emergency tariffs before then.
It's Tyler Kendall with the latest. Tyler, thank you. Joining us now to extend the conversation, Scott Lincicome of the Cato Institute. Scott, welcome to the programme. Interesting exchange with the president in an interview broadcast here in the United States in the last 48 hours or so. Scott, the president was asked about tariffs, and he brought up the example of Switzerland, and he said that he didn't like the way he was spoken to, so he ratcheted up the tariff just a little bit more. Does that undermine the official justification for these tariffs?
Well, it certainly does. This is supposed to be about a national emergency that requires, it's an event that's so abrupt and so urgent that the president needs to invoke powers that are typically reserved to Congress and that the president typically isn't allowed to access. So if the whole basis for these tariffs is not the trade deficit or fentanyl coming across the border, and instead is the Swiss representative's voice, then the president shouldn't really have the ability to invoke these tariff powers at all.
Scott, this is definitely going to be something that I'm sure the Supreme Court is paying attention to, at least the lawyers who are arguing for it. I am curious about what Tyler was just talking about, which is that you are getting some pushback now from Republicans around some of this tariff policy, in particular tied to affordability concerns and how this is playing through to their voters. How much more of that do you expect?
I expect a lot of it this year. In poll after poll after poll, the president's tariffs just aren't popular, and voters have tied them to continued concerns about affordability. You know, economists don't want deflation, but voters do. And the fact is that while inflation is slowed, prices definitely haven't gone down, and particularly for key staples at the grocery store like beef. And so you're going to, I think, see continued connection of the tariffs to the affordability issues. And you're going to see Democrats, I think, use that as a lever, including through symbolic votes like the one we're going to get, I think, today, if not tomorrow.
Right. This is the reason why people haven't been paying attention to symbolic votes, is because they are symbolic. And that's the reason why the Democrats have kind of been a little impotent on this. The interesting aspect is that there are a number of Republicans that are starting to join forces. And I do wonder how much heading into and after the midterms you start to get a real check coming from some Republican constituents based on what they're hearing from voters. Do you see that as crimping some of the tariff plans that have currently been laid out?
Yeah, you know, quite frankly, I don't think that the Congress is going to have the ability to do too much to stop these emergency tariffs under the International Emergency Economic Powers Act, simply because they're going to need veto-proof majorities to get past Trump. So even after the midterms, I think it'd be really difficult for Congress to really pass any sort of tariff reform, whether it's to the emergency tariffs or to the national security tariffs under Section 232. I mean, I'd love to see it, but the reality is these institutional checks are pretty weak because of the veto-proof majority necessity. And that's why I think one of the reasons why the Supreme Court's decision, whenever we get it, is so important here, because that would be a legitimate check on those emergency tariffs if the court really does say the president's not allowed to use them.
Scott, we've seen lots of justifications for the tariffs that were introduced a year ago: raising revenue, national security, bringing manufacturing home, getting your own back when someone upsets you on the phone, all of those things. The number one issue for me, Scott, is getting China to rebalance. And the Treasury Secretary had come out repeatedly and articulated quite perfectly as to why we need to do that, and not just us, the Europeans as well. Now, Scott, I think it begs the question now, after the evidence of the last 12 months, what we can actually do about that, because that trade surplus from China has never been wider despite the tariffs introduced last year.
Yeah, it really shows the limitations of unilateral tariffs to do a lot to change foreign government behavior, particularly when it comes to a massive economy like China that's dealing with really systemic issues that simply can't be fixed by, you know, subsidizing a factory or removing a subsidy or something like that. So the fact is that you need a lot more than simply applying a tax on some imported goods to fundamentally change China's economic model. And quite frankly, you might not be able to do it at all. Unilateral policies coming from a single government tend to produce backlash in the target country. You've seen some of that in China as well, where they're actually doubling down on nationalization and self-sufficiency efforts. And then the last thing, of course, is that Trump's tariffs haven't just targeted China. When you're also targeting China competitors like India, Vietnam, Malaysia, even Mexico and Canada, it makes it even harder to induce those types of changes. And I think, again, that's why we've seen record exports out of China simply getting moved to third countries that don't have Trump tariffs attached to them.
A record trade surplus last year. Scott, thank you, sir. Scott Lincicome there of the Cato Institute. Up next on the programme, Sucharita Kodali of Forrester. Snapping a two-day winning run on the S&P 500 with a very mild day of losses this morning. A mild bounce up by, let's call it 0.2% on the S&P 500 and round this up. Still within 1% of all-time highs on the S&P 500. Switch it up and get to the bond market. 2-year, 10-year, 30-year yields shaping up as follows. Yields lower again. Yields are down every single day this week so far, Monday through Wednesday. The 10-year back down to 4.13 and fueling that move. Weaker than expected economic data, which is just lowering the bar just a little bit and putting more weight and more emphasis on the payrolls report at 8:30.
Yeah, it's the fact that we didn't just get one data point that was weaker. We got several in a row. We got retail sales, and then we got consumer delinquencies ticking up. We also got commentary from a host of companies talking about how the lower income consumer is really under pressure. At the same time, Hilton's just reporting earnings and saying we only see tailwinds, and we're honestly increasingly optimistic about our performance, and they beat expectations. So it is a very difficult picture to really come up with some sort of cohesive narrative.
Heard the same from Marriott.
Exactly.
Yeah, Brian Moynihan. Speaking to Leslie Picker yesterday, same thing.
Exactly. We expect a strong market ahead. We expect a strong economy. So how do you get a cohesive narrative? And this is the reason why so many people have been pricing in dynamism. You're hearing that a lot. You're also hearing the other side, and we may hear more of that today.
Forgot that really strong ISM from last week very quickly, didn't we? Just like that, kind of moved on.
IS what?
Exactly. It's the tug of war between that and the string of weaker than expected data we've seen over the past few days. Get to foreign exchange, the dollar down, weaker for 4 consecutive days. The euro stronger again, 119.14 on that currency pair. As we count you down to the opening bout a few hours away, let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We're seeing Lyft shares getting hammered in the pre-market, down more than 17% after it posted a surprise revenue miss and a disappointing outlook. But what's really adding pressure is the competitive landscape and the fear that as Waymo and Tesla expand their autonomous vehicle fleets, that ride-hailing as we know it may no longer exist. So the Lyft results not enough to allay those fears. Meanwhile, the crypto rout at the end of 2025 had a big impact on Robinhood. The sell-off cut deep into profits with fourth quarter net income sliding more than 30%. But Robinhood saying that its future is not tied to crypto, it's tied to prediction markets, with the CEO saying that it is the fastest growing business in the company's history. But that optimism not enough to lift shares, down 7% this morning. And we end on Mattel. Those shares are plunging nearly 30% in the pre-market after the toy maker posted a significant miss and issued weaker than expected guidance. The Barbie maker saying it expected a surge in sales during the holiday period, but it just didn't materialize. It says that consumers were hunting for deals and that retailers were handling their inventory very carefully. So a miss there. Shares are down 29% now. John.
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. On our radar this morning, rising fears of AI disruption hitting wealth management firms. The release of a tax strategy tool by the little-known startup Ultra sending shares of Charles Schwab, Raymond James and LPL Financial tumbling in Tuesday's trade. Elsewhere, Ford expecting profits to jump this year, even after a surprise $900 million tariff bill at the end of 2025. The automaker planning to ramp up production of higher-margin trucks and SUVs after pivoting away from electric vehicles. And finally, the White House adding to confusion over trade, a new fact sheet on the US-India agreement, removing references to agricultural goods such as lentils and chickpeas. The document also changing phrasing around India's offer to buy more American goods.
This comes with a lot of concerns on both sides, in particular in India, where a lot of farmers have been worried about some of the agreements that initially were laid out to buy pulses, which are things like lentils and peas and things that are really important. I think that India consumes something like a quarter of the world's total pulses. There's a bigger point here, though, and it goes to the Ford issue as well. The fact that Ford, on December, I believe, 23rd, got a note from President Trump saying they missed something and that they had an extra $900 million charge shows how messy it is to get your hands around some of these proposals. That was actually a proposal that had gone into effect. The India-U.S. trade deal still isn't in effect, and clearly a lot of the fine print's getting worked out.
Execution's been a problem in the last 12 months. I think I'm understating that just a little bit. Going into the midterms, I would say this about tariffs, trade, and the White House. Watch what they do and not what they say, because what they will tell us repeatedly is this is good. And I understand the rationale for them, particularly with national security and bringing some manufacturing home and relying less on China. But when it comes to the midterms and affordability, if you want to make the case that tariffs aren't harming affordability, it's difficult when you keep turning around and providing carve-outs for the consumer. And I'm thinking of things like beef and seeing more of that in the months to come. So sure, they'll say this is good for the consumer, but when it really starts to count and we get closer to the midterms and we see more carve-outs, I think that tells you what they really think about some of these tariffs.
There have been a lot of issues with execution. On one hand, it's the rationale and how cohesive some of the arguments have been. There has been a sort of scattershot approach to justifying tariffs, and that doesn't work in order to have any kind of continual rationale. And then there's, of course, the question of exactly what these tariff regimes are, because we don't have details, and frankly, it seems like they're changing for the moment. So it raises this issue of, can we price out tariff risk for the rest of the year? And is the impetus going to be on reducing them because of legal and, frankly, popular challenges?
Affordability is a massive issue. Let's keep it on the consumer. Delinquency rates surging to the highest level in nearly a decade, according to the New York Federal Reserve. The data adding to a downside surprise on retail sales. Sucharita Kodali of Forrester writing, the consumer is not happy. Confidence is still extremely low, and AI tariffs, geopolitics and domestic polarization aren't helping. Sucharita joins us now for more. Sucharita, welcome to the programme. Let's talk about the tax refunds, because a lot of weight's been put on that, and there is a belief that will turn around this story. Do you share that belief?
No, because the tax refunds happen every year and they really don't have an amazing impact on retail sales. The bigger issues are the macroeconomic conditions of the consumer. And given that so much of the spending happens later in the year anyway, I don't think that these tax refunds are going to have much of an impact. It may be a short-term blip for a certain number of retailers like Walmart, but for the broader economy, it will be negligible.
We were looking through the delinquency data just yesterday. I'm sure you did the same thing. Where are the problems more acute at the moment? Is it just low-income consumers, where we've noticed a problem for quite a while, or are you starting to see that migrate up?
The delinquency issue is definitely growing amongst lower end consumers. But the truth is also that we are coming off of record lows for delinquency rates. And even though the number is increasing, it's still at historical lows. And I think that is there's the warning sign, but yet there's not the clarion call of the platform is burning quite yet. And certainly I think that factors like consumer confidence are a bigger issue, because that is being reflected in the sales of some of these even mass merchants, companies like Target. So that seems to be the bigger issue. When you look at debt levels, you'll hear a lot about debt levels going up. The upper end consumer, the most affluent consumers with the highest credit scores, are actually the ones taking on the greatest percent of debt right now. And that includes everything from automotive to home debt. And that is likely also buoyed by the fact that the market is doing well. So the lower end consumer isn't necessarily borrowing, but of what they are borrowing, which is often things like student loans, they are defaulting more frequently.
If the lower income consumer isn't borrowing that much, and frankly, if it's not world on fire types of data coming out of the delinquency side of things, why weren't retail sales better, especially given some of the guidance that we got from some of the big companies?
Well, I think that is what's happened with retail sales is that it has been essentially driven by the higher end consumer for some period of time. So you have not only the higher end consumer driving disproportionately greater sales, but that higher end consumer in many cases is also trading down. So they are more likely to even go to some of these mass merchants, whether it is Walmart or their standby staple, which has been Costco for years. So that's what you tend to be seeing. And then the lower income consumer is either cutting back or trading down entirely. So I'm not surprised by retail sales being flat. They've been trending relatively softly for a number of months. And we essentially see retail sales being at pace with inflation now. And with the fact that prices are higher, that actually means the number of units that people are purchasing is actually indeed lower. That doesn't bode well for 2026.
Sucharita, I saw in a number of research notes, lower income people are definitely having a harder time spending money. You're seeing this across a whole host of different metrics, but also younger people. And that was often put in tandem with low income. It was low income and younger people. I'm looking at a story about how Five Below is rebounding because Dubai chocolate's hot and they're really capitalizing on it. But I'm just looking forward. How bad, how dire is the situation for young adults, given the fact that you've got a labor market that is questionable, new hire market that's questionable, and frankly, the overhang of all of that debt you were just talking about?
Well, the younger consumer for decades has certainly been kind of the recipient of a number of challenges pretty much since 2008. They've always come into difficult economic environments, difficult economic circumstances, tough labor markets. There's more uncertainty now than ever before. And I think that's the big challenge. The expression I keep hearing is peak ambiguity. If we thought that March 2020 was a period of tremendous ambiguity, we are at an even worse time with respect to not knowing what the future holds. Young consumers certainly have been a recipient of that, and the level of student debt that they've had to take on. And anytime you have higher interest rates, which may change the variability in the overall payment structure, that's not a good thing either. And if you don't have a job to help offset and pay those loans, that's certainly a problem, and it's going to be reflected in ultimately retail sales as well, certainly for the stores that are addressing younger consumers. How things will change, typically the arc is that within 5 to 10 years, most of these consumers do settle down and they go to grad school or they ultimately get some other job. But what that job outlook is going to be in 5 to 10 years remains to be seen.
I missed that, Bramo. What's happening at Five Below? What's hot right now?
Dubai chocolate.
Oh, Dubai chocolate.
I don't know. I was actually just looking it up.
What is that all about?
So I was just looking it up, actually. You read my mind. You're looking at what I'm looking at. I was looking up, why is Dubai chocolate such a thing? You go into any store.
So what is it?
What is it? It's something that's a TikTok trend that is chocolate with layers of pistachio that are inside of it, and it's very rich, and so people are very excited about it, and you can charge a lot of money for it. So probably the margins are pretty steep, which is the reason why you see it at the checkout counters of pretty much every kind of...
Have you tried it?
No, have you?
No.
Obviously.
No.
Well,
no.
partly because...
I've seen it, just don't know what it is.
Partly because, A, I like dark chocolate.
Okay.
B, it feels gimmicky to me, and I have this immediate aversion to gimmicks. And C, like TikTok trends in general. I mean, I guess that goes with
I think
B.
we're months late to this. If the kids are watching, they're like, yeah, this was like last year's story.
This is like 6, 7.
Sucharita, thank you. Sucharita Kodali there, Forrester, thank you very much. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. At least 10 people are now dead and 25 others injured after a mass shooting in a remote town in Western Canada. Police found 6 people dead in a school, including the suspected shooter, who appears to have died from a self-inflicted injury. 2 other victims were found in a residence connected to the incident. It's Canada's deadliest shooting since 2020. Israeli Prime Minister Benjamin Netanyahu meeting with President Donald Trump at the White House today. Netanyahu is expected to push for a sweeping rollback of Iran's military activities and its ballistic missiles program. Israel concerned the U.S. will settle for a narrower nuclear agreement. Ford shares on the rise in the pre-market. The automaker is saying it expects its profit to jump this year, despite a surprise $900 million tariff bill at the end of 2025. The company plans to increase capital spending this year to as much as $10.5 billion. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie in the next hour. Up next on the programme, counting down to payrolls.
This is not an economy that requires a significant amount of job growth behind it. That's how you end up with this dichotomy of slower job growth, but an unemployment rate that could decline to 4.3%.
Steve Englander of Standard Chartered joins us next. His number for 8:30, negative 10K. That conversation in just a moment. Stocks are bouncing back by not even 0.1% on the S&P 500. A bullish note out of JP Morgan in the last 24 hours. Dubravka Lekos-Bucha saying, given the positioning flush overly bearish outlook on AI disruption of software and solid fundamentals, we believe the balance of risk is increasingly skewed towards a rebound. We had the same really from Cantor's Eric Johnson on this program yesterday.
Yeah, saying that he really thinks that that's going to lead an upward bounce, and you have seen some of that. There has been this question, Stuart Kaiser raised this, about how much of this is technical. How much is this CTAs? How much is this other traders that had certain programs that were blown out by some of the moves, and now it's resetting? And that does seem to be what's coming into the fore right now.
Looking forward to the payrolls report later on this morning. Some data at 8:30 Eastern time. Under surveillance this morning, counting down to the jobs report.
This is not an economy that requires a significant amount of job growth behind it. When we hear Kevin Hassett say, get used to lower numbers, but don't panic, an economist's take on that is, well, this is not an economy that requires a significant amount of job growth. That's how you end up with this dichotomy of slower job growth, but an unemployment rate that could decline to 4.3%.
So here's the latest this morning. Traders are awaiting the delayed January payrolls report due out in just under 2 hours' time. Steve Englander of Standard Chartered expecting a street low negative 10K. Steve joins us now for more. Steve, welcome to the programme. If we get 10K, should I panic?
You shouldn't panic, but I don't think the market's prepared for it. I think there'll be a lot of sticker shock, especially because the revisions are likely to be large and everything's going to look worse. I think it's complicated because it doesn't say that the economy is deteriorating at warp speed. What it's telling you is that the labor market was never as tight as we thought it was. And that's going to be the message, the ultimate message, I think, that they take away. But initially, I think we'll see a big market reaction, both in the dollar and in money markets and in bond markets.
Steve, how well understood do you think that is already on the FOMC, given the 3 cuts they delivered at the back end of last year?
Well, it's kind of understood. But I look at the Bloomberg forecast of 65,000. The consensus looks a bit high. It doesn't look to me as if the market's fully factoring in the magnitude of the move that's going to be made in terms of revising the data. Now, it could be that there's going to be this colossal footnote, and half an hour later, everybody's going to get it. But I think initially there will be some surprise there.
So, Steve, many people will come on the programme, I'm sure, and make the case that the so-called break-even rate is lower, that there are supply-side factors at play. The real slack indicator is both unemployment and wages. What do you expect to see in those 2 data points today?
I mean, we're pretty much at the consensus on the unemployment rate. Look, I think the unemployment rate is gradually rising. All the indicators suggest that the labor market is on the weak side, not 3 standard deviations weak, but maybe 1 standard deviation weak. And that's kind of what's showing. PMIs are in the 40s. That's not a recession. If they were in the 30s, that would be a recession. But it's certainly not good. And I think that that's sort of the overall message we're getting. Weak-ish labor market, but not a disaster.
Steve, hasn't the market already been primed for a bad number based on some of the rhetoric that we've heard from the administration? Albeit, the administration did clarify yesterday that both individuals who talked about this did so before seeing the actual report. I am curious, though, how much has this market already priced in something like what you're talking about?
I'm just not sure. I mean, I Googled birth death, which is the big adjustment that they're going to make, NFP, BLS. There's just not that much that's been written on it. And when I see we expect a downward revision of 60 or 70 because of the change in that model. It's hard for me to see how you get a 65K consensus if that's, actually, if we're right. And I hope we're right.
Steve, you Googled. You didn't ChatGPT. The reason why I say this is because ultimately there's a real question behind some of these numbers. How much is this because of immigration? How much is this because we just have a smaller population? How much is this efficiency? And how much is this something different, structural, where smaller businesses don't have the confidence to invest in people when they're investing so heavily in infrastructure that could potentially change their need for people? Do you have a sense of how we can parse that out in some of these numbers?
I think it's very hard. I really think we don't even have a good sense of what population is. If you look at the way BLS handles it, they just throw population change into January of every year. And last year they threw 3 years of immigration into January numbers. So it makes no sense whatsoever. Immigration, we really don't have a census of, immigrants, undocumented immigrants especially. So we don't know where they were in the labor market. So I think it's going to take a while to figure out. And well, as you said at the beginning, I think we'll have to watch everything that's supposed to be correlated with labor market strength, whether it's wage growth, whether it's the unemployment rate, other indicators, to really be to sort of figure out what's going on, because I think the numbers that are supposed to tell us what's going on are a bit shaky because of the way the economy has shifted, and BLS really hasn't kept up with those shifts.
Well, Steve, we've got more data on Friday. We've got the CPI report. What are you and the team looking for on Friday, and how wide open is the door to an interest rate reduction in the time left that Chairman Powell has running the Federal Reserve?
We don't know how wide open it is because, we get labor market data, price data a couple of times a week, in one form or another. Everybody's talking productivity growth. And even with yesterday's week numbers, we're still like, in well into the threes in terms of expected GDP growth. I think that's increasingly the story that's going to drive things. And I think the Fed, after 3 cuts, the Fed's going to wait and see whether there's any indication that labor markets are really deteriorating, faster than they were or stable. So I think ultimately they don't move. That's our view, that they don't have to, and that the equilibrium real interest rate is higher than the, flat 0.5, the very low numbers that they've been putting out. So we don't think that they're going to move at all.
Steve, consensus feels a little flaky. It feels a little almost lazy. Torsten Slock of Apollo talked about this. Given everything in the pipeline, we've basically got people around 2% for GDP for the year ahead, 2.4%, something like that, and 2 rate cuts from the Federal Reserve. Steve, do you think that masks a much greater divide on Wall Street, where there is a camp of people who believe we could see 3% GDP and a conversation about hikes, and then another camp where they think that growth could fall off a cliff and we'll be talking about cuts again at the end of the year?
I think there is, even with the productivity numbers that we expect in strong GDP, that looks increasingly likely. I don't think a hike is on the table because the productivity growth keeps a lid on unit labor costs, and the Fed will be watching that very carefully. But there is this dichotomy between people like us who look at the productivity and output numbers and say this is fantastic. It's really shifting. And there is a camp that focuses on the labor data and says, ultimately weak labor markets are going to drag down the rest of the economy. And there's, the Fed is going to have to react. You can make the argument, and we disagree, but you can make a solid argument that that's the case.
Steve, it's good to see you. As always, thank you, sir. Steve Englander there of Standard Chartered. I'm probably not choosing the best words, but let me have another stab at it, another go at things. I think the average right now masks a much greater divide on Wall Street at the moment between the bulls and the bears on the US economy and what the Fed's going to do by the time we get to year end.
I think a lot of people would agree with you. There are people who think the economy is going to fall off a cliff and that's going to be 5, 6, 7 rate cuts. And then there are people who think that there are going to be no rate cuts and we're going to be contemplating rate hikes at the end of this year. And so you've got the average of those two that looks like a pretty continual, gradual easing cycle, which is what the Fed is saying. But ultimately what you see under the surface are people who see the economy truly breaking out in one direction or another. And that, I think, is sort of the tail risk that isn't being expressed in equities and some other risk assets.
You'll see this again at 8:30 Eastern Time. Let's say we get, 20K. Let's say we get 20,000. You'll have one economist come on the programme and say, that is absolutely dreadful. Governor Waller's right. We're on the edge here. We need to cut more. And you'll have someone else come and say, the break-even's around that. Don't worry about it. There's lots of stimulus in the pipeline. We'll be at 3% GDP growth by year end.
Yeah, economic data has become a Rorschach test. And we've seen that for the past couple of years. People talk about how the data is not reliable, how it's muddy. Even if it is reliable, what do you do with it? This is the reason why people are looking at some of the revisions to understand just the momentum behind some of these numbers. But even then, what do you do with it? And ultimately, do we need people anyway in this recovery? I mean, so it's like you could go any level of derivative away from this question to understand exactly how confused people are. Ultimately, it's going to come down to earnings and ultimately the unemployment rate.
As a preview of the conversation about 2 hours from now. Up next on the programme, Lisa Shalett of Morgan Stanley, Wealth Management, Tobin Marcus of Wolfe Research, Binky Chadha of Deutsche Bank, and the former St. Louis Fed President, Jim Bullard, the second hour of Bloomberg Surveillance. Up next.
What we're starting to see is more of a rotation.
That S&P equal weight is where the overperformance has been.
Earnings growth will still be driven largely by tech.
Investors are more worried about being left behind.
What we have ahead is a very good backdrop for equities.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. It's payrolls Wednesday, the data 90 minutes away. Equity futures on the S&P 500 just about unchanged. Likewise on the Nasdaq and the bond market. Yields near the lows of the year. On a 10-year maturity down around a basis point, 4.13, with the jobs data just around the corner and the number we're looking for, something around 65K.
Yeah, and the real question will be the unemployment rate, because we have to understand what exactly 65,000 looks like. Then you also are going to get benchmark revisions for the full year of 2025. What do those look like in terms of the momentum? And ultimately, this comes at a time where a growing number of people are questioning the bull market thesis in the economy, not necessarily in capital expenditures, but in the economy, and how far that can fuel some of the trades that have gained popularity, including the cyclicals.
So what are you pushing back against? You're pushing back against the rate cuts we've already seen, the tax refunds we're about to get, and a massive capex, $650 billion worth for the year ahead across 4 companies. So add some on top of that. How hard is it to fade that story into the year ahead?
It's very hard, which is the reason why I think a lot of people are finding difficulty doing so. At the same time, how much has this been overpriced? I think that there are two sides to this question. We have to look at how fully that has been priced in, and then what some of the flies in the ointment might be, which is that people aren't getting jobs. So that's a little bit of a fly in the ointment. You start taking a look at retail sales. Oh, yeah, and they're also not spending that much more money. Oh, that's a little bit of a bummer. So you start looking at this and you say, how far can the economy fall off a cliff, and how much can that challenge some of the bull thesis?
Do you think to some extent as well, Bramo, that the market channel starts to infect the Main Street economic channel as well? The headlines we saw last week in software, in the last 24 hours in financial services. If you work in those industries, you'll be taking those stories seriously. And when you start to plan the summer vacation, the spending on big ticket items for the year ahead, is that going to hold you back just on the margins, just as you get a little bit more wary about the industry that you work in?
Well said. I would say that, and I would build on it. Not only are individuals holding off, but so too are companies, small businesses. Why would a small business invest in itself if it doesn't understand what its own business model might look like in a year? If you look at peak uncertainty, this is the reason why the engine of hiring, which is small businesses, I think that they account for some 70% of hiring in the United States. How much are they going to really invest in bringing on new people if they don't understand whether they're going to have to lay them off in a year, or whether those people are going to drag down the profitability?
It wasn't my intention. This got gloomy very fast in the last 2 minutes or so.
It wasn't gloomy.
Not even trying.
These are the real questions that people have ahead of payroll.
The stocks are doing okay. We're up by 1/10%, within 1% of all-time highs. Coming up this hour, Lisa Shalett of Morgan Stanley as AI disruption shakes markets. George Pollack of Signum as contradicting views on jobs numbers begin to emerge in Washington. And the former St. Louis Fed President Jim Bullard on the central bank's uncertain future. We begin this hour with stocks ticking higher following a wealth management sell-off sparked by a new AI tool. Lisa Chadha of Morgan Stanley writing, with much ink spilled on equity volatility, transparency and composition matter in this moment, with selectivity key for fixed income investors. Lisa joins us now for more. Lisa, good morning. Good to see you.
It's great to see you.
Let's start with small caps. Are you fading that trade? Is it time to get out?
We have 100% faded the small cap trade. Our sense is that there was a lot of enthusiasm, premised on this idea that we're going to get this big reacceleration in the economy. But what people forget is that the small cap cohort is really, really low quality at this point. We've gone through, literally a decade of private equity picking off the most durable, leverageable business models. And what's left in the public market, literally 43% of the Russell 2000 is unprofitable. 8% of the Russell 3000 is unprofitable. These are companies that are unprofitable against a backdrop where U.S. nominal GDP growth has been over 5%. I mean, we've had a wind at most companies' backs between inflation and pricing power and real growth. And if these guys can't be making money in that environment, my goodness, are they going to, if the economy slows, God forbid, are they going to be able to make money? So we think that this was definitely a knee-jerk playbook trade. Hey, we're going to get stimulus, we're getting reacceleration, pile into small caps. I think it's going to be really hard when it comes to show me the money in the earnings season for these guys to meet and beat.
So if the bias is large cap over small cap, where's the leadership coming from in large cap?
We think we're going to go back to a high-quality large cap trade. That means, in fact, some of the Mag 7, right? I think we've seen some of that selling off or that dispersion trade a little bit overdone. So there's probably some of those guys that you can start picking. Some of the software trade is probably overdone. We're continuing to buy. We loved the sell-off in financials yesterday because financials is our #1 high conviction sector. So we're, piling into that silly sell-off yesterday, and we genuinely think it's silly. We like industrials, we like energy, we liked healthcare. So, we think it's a stock picker's market, so you got to be selective. But the idea is rotating back to quality.
Just in case people believe there's a wealth management bias here.
Yes.
What made it silly?
So I think if you take a step back, while there is no doubt there are going to be disruptive technologies, disruptive applications, I think that there's a material misunderstanding about the way a lot of these businesses work. Let's take software, right? So I don't have to speak my own book. In software, one of the key things that a lot of these enterprise software companies have been able to do is capture data. They own the data, and they've owned cleaning up data and unifying it across the enterprise. No matter how good of a Gen AI tool you have, it is premised on using and learning your data. And so I think that the end game here is going to be a lot more nuanced than this, let's rotate and throw the baby out with the bathwater with these big sector moves.
The problem for an investor, the problem for me trying to understand this is on one side of the ledger, you have the potential disruption that could eradicate certain business models, but also benefit some of the high quality names that you're talking about. This is the promise that's getting priced into some of the valuations. So on one hand, either those are priced too high, or the disruption is perhaps a bit more real than we had expected. Which is it?
So I think it's a little bit of both. And I know that that's a very unsatisfying answer, but we are going back to a market where fundamental analysis, where that real hard work of stock picking, of discriminating, where, this is an environment where we think, quite frankly, some of the hedge fund managers are going to be able to thrive after a decade of them kind of, barely meeting fixed income type returns, right? So it's all about picking quality, selectivity, doing your homework.
A lot of people have talked about quality as gold. People have talked about quality as precious metals. And that has been one of the key sort of safe haven assets out there. You are starting to cast some doubt on that particular trade. Why?
So I'm not so much casting doubt on the gold trade. I'm casting a lot of doubt on the silver trade, a lot of doubt on the Bitcoin trade. So gold is has a very interesting story associated with it. Obviously, the first is around global de-dollarization, central banks diversifying. But the other piece of the story that I don't know is well syndicated or, quite frankly, even well believed, is that ultimately non-dollar stablecoin issuers, right, are beginning to build collateral to issue non-dollar stablecoins. So the second largest buyer of gold last year was Tether. Second largest buyer of gold. And they are doing that for a reason, because they know that they are going to have opportunities to collateralize in a non-dollar stablecoin. And that's a way to give their stablecoins legitimacy. So I think that there's a real story around gold that is very, very legitimate. Silver, I think, has been a truly kind of speculative. Yes, you had a supply-demand, divot there, but I think it's excessive relative to gold, and so we'd be selling silver. And Bitcoin, we've been very clear, it's a speculative, liquidity-driven asset class. When the global liquidity is building, it's something that potentially you can trade. But increasingly, we have done work across the lifetime of Bitcoin and have seen this seasonal pattern, that it goes through these crypto winters where you get these big bear market sell-offs. And we think we're in one of those big bear market sell-offs. So we'd be avoiding Bitcoin for right now.
Let's stay on gold.
Yes.
Given the forces behind it that you described, what role does that kind of thing have in a portfolio?
So what's been spectacular is that gold has been one of the few things that has diversified stocks. Gold's correlation with traditional things, right, like real assets or the U.S. dollar or inflation break-evens, is completely broken. But what it has done a really good job at is diversifying stocks.
Because if I look at the charts, the pushback would be just eyeballing the thing. They kind of look the same. Stocks are up and gold's up. And it's correlated with risk.
That is true, but on the days that stocks have been down, gold has done a better job than long-duration treasuries.
What role do treasuries have now?
So that's a great question. I think it's really about coupon clipping right now. I think it's going to be very hard to use long duration and use TLT, for example, to hedge your stock as a diversifier. I think this is about kind of sitting in the belly of the curve, between kind of, 4 and 7 year duration and just clipping the coupon and saying, yep, we've got a steep curve down on the front end, up on the back end. I'm going to try to stay stable here and just collect, 4 or 5%.
Torsten Slok of Apollo just publishing. I'm sure you saw the note drop into the inbox. Bond yields should be higher because he is super bullish this economy.
He's the one who's talking about potential rate cuts or discussions of rate hikes. Rate hikes. Thank you for correcting me. Later this year, because of how strong the economy is. I'm just sitting here thinking, you've got asset classes that are being financialized that have never been financialized before. I'm thinking about gold.
Sure.
In order to avoid using treasuries as the classic haven trade. So you could say whatever you want about whether treasuries will act that way. But there is an entire industry trying to financialize things like gold, things like Bitcoin, because they want that alternative and they're looking for other hedges. I just wonder what that does in terms of some of these violent sell-offs and moves that you see in the algorithmic trading. I wonder how much that's part of it.
I saw a story about that. Isn't it in a massive vault somewhere in a cave?
Yeah. Yes.
Very interesting story. I read that recently too. Lisa, thank you. Lisa Shalett
Absolutely.
there of Morgan Stanley. Equity futures on the S&P positive by 1/10 of 1%. Let's get you an update on stories worldwide with your Bloomberg brief. Is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Mattel shares plunging in the pre-market. The toy maker reporting disappointing results for the holiday season. The maker of Barbie and Hot Wheels also forecasting full-year guidance that fell short of Wall Street estimates. Saks is closing more than 10% of its full-priced stores across the United States. It's part of the company's effort to come back from bankruptcy as a smaller, more profitable department store. The stores closing include those in New Jersey and Philadelphia, which have been mostly unprofitable. President Donald Trump is weighing quitting the USMCA trade pact. Sources telling us here at Bloomberg the president has asked aides why he shouldn't withdraw from the agreement, but hasn't signaled his final decision. The trade pact faces a mandatory review before a possible extension on July 1st. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Just to clarify, Tether stores that in a Cold War-era nuclear bunker in Switzerland.
So,
did you read that story recently? It's fascinating.
Would you like to try to
do a tour?
Yeah, I think that we should take...
Undisclosed location, I believe.
I think that we won't disclose it. We'll take surveillance on the road. We'll go to the vault. We'll say, we'll be in the nuclear-era bunker.
Keep the secret.
We'll keep the secret, and we'll just sit there with the gold.
Did we ever do the tour of Fort Knox? That was meant to happen too.
We would like to do that.
That never happened.
Outstanding.
Up next on the programme, preloading, payrolls.
I've cut hundreds of thousands of jobs, and we still have good employment numbers. But if I want to have the greatest employment numbers you've ever seen, all I have to do is say I'm going to hire 500,000 people.
Up next on the programme, George Pollack of Signum, live from New York City this morning. Good morning. The delayed jobs report, 1 hour and 15 minutes away. The estimates, the range pretty wide. At the top end, 135, at the low end, -10. Citi at the top end at 135. The median in our survey here at Bloomberg, about 65K. Going into that report, equities look like this on the S&P 500, the Nasdaq, the Russell, up by 1/10 of 1% on the S&P, on the Nasdaq up by 0.2. If we turn to the bond market, yields pinned to the floor this week off the back of weaker than expected economic data. Lows of the year at 413, around those levels on a 10-year maturity at the moment. And then this note drops from Torsten Slok of Apollo. 10-year bond yields should be higher.
He looks at how much he expects the economy to accelerate, and he's in the camp of seeing some of the One Big Beautiful Bill tax refunds really driving consumer spending, as well as some of this CapEx. Meanwhile, other people are saying, hold on a second, real people are struggling, and you're not seeing that in the numbers, which is the reason why even Citigroup, seeing 135,000 at the highest end, they are so bearish on the economy. You wouldn't know it, that the headline numbers aren't necessarily going to reveal the underlying pain. So you have these two bipolar stories, put them together, you get some nice averages, but ultimately it is a lot more bifurcated.
Huge division beneath the surface, without a doubt. You mentioned Citi. Andrew Honhorst looking for another 75 basis points. 3 cuts from this Federal Reserve. And the surveillance this morning, preloading payrolls.
They talk about construction jobs are way up, right? Well, they're up because they're building all these factories all over the country. Our employment numbers are very good. But remember, we have to make America great again, right? You don't do that by hiring all federal workers. We want them to be in the private sector. I've cut hundreds of thousands of jobs, and we still have good employment numbers. But if I want to have the greatest employment numbers you've ever seen, all I have to do is say I'm going to hire 500,000 people.
So here's the latest this morning. President Trump touting U.S. employment data ahead of the delayed January jobs report. The president's rosy outlook coming in stark contrast to a warning from the NEC director, Kevin Hassett, saying, quote, one shouldn't panic if you see a sequence of numbers that are lower than you are used to. Bloomberg's Tyler Kendall joins us now for more. Tyler, don't panic but is never a great way of starting a sentence.
No, it's not, John, and it does seem like there are some conflicting views out of the White House as top administration officials appear to be lowering the bar ahead of today's report. But President Trump has only raised the bar when it ultimately comes to growth. And it's not just the NEC director, Kevin Hassett. We also heard from senior trade counselor Peter Navarro yesterday, who in an interview said that, quote, we should revise our expectations down significantly for today. Now, we know there are, of course, a range of factors, but I'll give you the White House's view going into this report is that they have been arguing that potential low hiring number today doesn't necessarily paint the full picture when it comes to the labor market, as they talk about a decline in population growth and also the president's deportation policies. Meanwhile, if you hear President Trump in recent days when he's talking about the economy, he seems to be really focused on an expansion fueled by other things like CapEx spending, the AI boom efficiencies, also onshoring manufacturing. You heard him talking about construction jobs in that interview there. So a range of factors that the White House and President Trump seem to be looking at when it comes to this. But ultimately, no matter what happens today, this is an administration that is under pressure from American voters when it comes to the economy, and we head into the midterm elections. In fact, I'll point you to a new poll out from Gallup just this week that shows nearly 50% of Americans have negative views when it comes to the labor market. And John, I'll also quickly mention, keep in mind, this has been definitely a soft spot for President Trump when it comes to his views of this jobs data. Today's report will be the first report since he named his new head of the BLS. Brett Matsumoto hasn't been confirmed yet, but his nomination about 2 weeks ago came after months of that spot remaining unfilled.
Tyler Kendall with the latest in Washington. And just to be very clear here, Director Hassett isn't wrong. There are supply side factors at work that most people, in fact, I would say all people that come on this program endorse. It's just to what extent? And can you escape what's happening with the unemployment rate, which is a decent measure of slack and is higher now than it was 12 months ago?
It's the reason why you point to the employment cost index, and rightly so. The idea that wages really tell you whether there's heat in the economy in terms of the labor market or not. And ultimately, what you're seeing is the employment cost index going down. In other words, how much people's pay is increasing is slowing down. This doesn't speak to a robust labor market, and it speaks to a demand side issue, not just a supply side issue.
Combined with massive sentiment issues, the idea that people's attitudes towards the labour market have really soured, the idea that things aren't as plentiful as they used to be when they look for jobs, and is that starting to infect and constrain spending on the consumer's behalf? Coming into the new year, you certainly saw that in the retail sales number. And I have to say, you know, I'll reveal a bias, bullish the US economy, we all should be. I don't want that to be the story for the year ahead. We want to see people feel confident about their prospects to get a job, to spend money. But that's soured in the last couple of weeks off the back of the data we've seen.
Yeah, I saw you ordering Dubai chocolate in bulk because you wanted to try it.
Right down the phone in the commercial break.
Clearly, because you are bullish on things like that are sold at places like Five Below, which is actually doing extremely well.
Which needs my help at the moment.
Exactly. They do with some management shifts as well. But look, you take a step back, you're absolutely correct. And this is a reason why retail sales spooked a lot of people. This is the reason why you pair that with defaults creeping higher. Not a 5-alarm fire, not, oh my God, the world is falling, but this does signify some weakness that people haven't priced in.
George Pollack of Signum joins us now for more. George, the President and the White House, the Republican Party's got a problem. You can see it in the polling. Did they have enough time to turn the story around?
I don't think they have enough time to turn the story around. What I think they need to be able to do is reframe the story between now and November and basically say, we are making a large bet on reshaping the U.S. economy for the 21st century, be it onshoring manufacturing, being a large bet on nuclear energy, and saying, we're not just focusing on the next 12 months, we're focusing on the next 20 years. And I think for the president, he has to focus on that message, the idea that I'm not just doing this as short-term policies, I'm doing long-term policies. And in the long run, this will be what's better for you because, as you guys were saying, in the short term, there's not much for them to do.
George, it seems like the messaging has really consolidated around one theme, and John was laying it out, that ultimately the reason why the jobs numbers are a lot lower is because of less immigration and the idea that you need fewer jobs to keep a balance to the employment market. Based on just polls and your research, how much is that actually breaking through to the voter population?
I don't think it's breaking through whatsoever to the voting population. All they care about is that when they look at the job market, when their kids look at the job market, when graduating from college, that they're struggling or they're perceived to be struggling to find jobs. I think for this administration, the issue is as much, and it's kind of like the Biden administration, as much as they want to say, look, this is happening for a reason, it's all good. When the voters look outside their windows and look at the kids, look at the people around them, all they see is economic weakness.
You know, I wonder if we're framing this in the wrong way. I mean, politically, it's framed as whoever's in the White House it's their fault. At the same time, if we talk to economists, we talk to a lot of structural changes, a lot of entrenched issues that have really hampered some level of hiring. How much is this something that can be addressed with rate cuts, that can be addressed with fiscal, and how much is this something that needs to be balanced out when we really understand the technology?
I think you've hit the problem spot on, though, where you're right. We can not only blame the White House, you have to look at economic factors and other contributing factors, but the president is the one who built himself into this box where he blamed President Biden, and in the past he's blamed President Obama for weak job numbers. So now he's holding the bag of weak job numbers, and he can't just say, like President Biden and President Obama did, that, well, this is structural, this is why it's happening. He's built himself he's put himself into a box canyon, and he can't really get out of it.
I've got a really welcome counterpoint to all of this, just dropped in my inbox. It's from Bank of America. And Bank of America, by the way, have already said fade any of the weakness that you see in consumer spending. This is based on their internal data in their Consumer Checkpoint report. Consumer spending showed solid resilience in January. So let's park December. January, with total card spending rising 2.6% year over year, the strongest paced in nearly 2 years.
And this goes with what we heard from Brian Moynihan yesterday. Brian Moynihan saying that they're investing more, that they see consumers spending 5% more in January than years earlier. So really expressing that confidence that they're seeing in that credit card data that you're talking about. So just how weak are things? Again, this goes to the Rorschach test of 2026. When you see that data, when you see the dots, what is it that you see?
Look, the bifurcation is what we still see. So you can have great aggregate levels, the average level of spending, fantastic. You see that in the data. Beneath the surface, and Bank of America is saying it, income-based divergence in spending and wage growth persists. We're concerned that a K-shape is opening up between higher-income households and middle-income households, alongside the existing gap with lower-income households. So it's not for us to sit here and say there aren't any problems, that what people are saying about how they feel about the economy isn't real. You're seeing that in the data. It's just the average numbers right now are still pretty decent.
The key here, middle income, is important. The idea that what it means to be low income has really shifted, because a lot of people who are caught in the $200,000 income or $250,000 income are struggling to support a household of 4, 5, 6 because of some of the costs that you have. I'm thinking of that essay that was really fascinating, laying out what does it mean to be poor in this current environment. And I think that's shifting, and that's what they're pointing to.
Yale just told you that if you earn $200,000 a year, you can't afford to send your child to our university. They basically just told you that. $200,000 a year is not enough now to send your child to college. That's a problem.
Especially if college costs are not going down. You're seeing $70,000 to $90,000 a year, especially if essentially you're not seeing wages increase at a faster pace and we don't have an employment picture. I mean, this is really the structural challenge that we face.
So the spending numbers are decent, but the upper income cohort is doing more and more of the heavy lifting, and that gap is opening up, and the problems are starting to migrate upwards. That's an issue. Hey, George, it's good to catch up. Thank you, sir. George Pollack there of Signum. Binky Chadha of Deutsche Bank up next. Jobs number 60 minutes away. Equities doing OK, up 0.1%. A little bit softer in yesterday's session, but no real drama. Some drama in wealth management firms. We'll talk more about that later. On the Nasdaq 100, up by 0.15. On the Russell, up by 0.2. Just moments ago, Morgan Stanley's Lisa Shalett making the case to get out of small caps, really pushing back against the case for moving away from large cap equity.
The number one case that she made is, who are these companies that haven't made it to either large cap capacity or moved on? Ultimately, they are pretty low quality. And she said something like almost half of them are unprofitable. So if you have some sort of rollover in the economy, these are the most susceptible, and they're getting bid up because people view them in the same light as they used to, which is higher quality, not necessarily the dregs.
Binky, Chadha of Deutsche Bank is going to weigh in on the dregs, if we can call it that, in just a moment.
Well, I mean, that's sort of
Not sure how
you're
people feel
describing
about that. Okay.
I don't think that's fair.
Switch on the board and get to the bond market. In the bond market right now, yields are lower again, 4.13 around the lows of the year. We're down a basis point on a 10-year maturity, and the data got us here. Plus some comments from Kevin Hassett, the director of the NEC, suggesting that maybe that number today might be smaller than anticipated.
Yeah, expect smaller payrolls numbers coming out because of the immigration backdrop, et cetera. That claim was repeated, or that type of tone is repeated by other advisors to the president. And then the White House came out and said they hadn't seen the report ahead of time. This isn't a tell. And yet the market's going, yeah, we believe you. And it seems like people are keeping this trade on. Look, we are pricing in more rate cuts, potentially even in April, which would be the last month that Jay Powell will be the chair of the Federal Reserve, ostensibly. And potentially he could even initiate another rate cut in his tenure.
Jolts, jobless claims, challenger job cuts, retail sales. Data hasn't been great. ISM is the offset to all of that. The ISM manufacturing number was actually pretty brilliant. ISM services was middle of the road, okay. Are we going to see more of the ISM or more of the others?
Maybe both. And this is sort of the key, because even the ISM figure, if you looked at the employment component, it came in below expansionary territories. We still haven't seen the employment component pick up even in one of the better areas. So can we see that boom without the employment? And I think that is the underlying question.
So jobs data are about 60 minutes away. The opening bell about 2 hours away. With your morning movers, Yahara has more. Hey, Yahara.
Hi, John. We start with Kraft Heinz. Shares are falling 6% in the pre-market after the company said just moments ago it is pausing its plan to split into two companies. Remember, back in September, Kraft Heinz said it would split into two firms, one focused on its fast-growing condiments and sauces, the other on slower-growing products like Oscar Mayer. But now the new CEO says he wants to focus on returning the company to profitable growth before any split takes place. Meanwhile, moving on to Cloudflare, those shares are rising nearly 14% in the pre-market after the company not only beat expectations, it also raised its revenue forecast. This is a company that got dragged down amid last week's software sell-off. But Cloudflare is not just software, it also provides the infrastructure to run secure systems. And the CEO says they're shipping capabilities at an unmatched pace. And we end on Moderna shares. They are falling nearly 10% in the pre-market on news that the FDA refused to review its mRNA flu vaccine, the latest sign of tougher oversight on vaccines by the Trump administration. Moderna says it wasn't about safety or whether the shot worked, but how the study was conducted. So they are seeking an urgent meeting with the FDA. John.
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. On our radar this morning, increasing concerns about AI disruption hitting wealth management firms. The release of a tax strategy tool by the little-known startup Altruist, sending shares of Charles Schwab, Raymond James and LPL Financial tumbling in Tuesday's trade. Elsewhere, the president discussing the prospect of leaving the USMCA trade agreement. Sources telling us here at Bloomberg the president is privately asking aides about the move. The trade pack is due for a mandatory review before a possible extension on July 1. And finally, the president also continuing his push for the Federal Reserve to cut interest rates.
Interest rates should be lower. You know, every point is $600 billion. Think of that. $600 billion. All he has to do, if we went down 2 points, we don't have a deficit anymore.
If only it was that simple. The president previously claiming his Fed chair pick, Kevin Warsh, can grow the economy by 15% if he, quote, does the job he's capable of. And based on the data I've just seen, middle-income workers would agree with the president because they would like a rate cut and fast. I want to go back to that Bank of America consumer checkpoint data that I mentioned just moments ago. Consumer spending, based on the internal data from Bank of America, doing quite nicely in the month of January, with total card spending rising 2.6% year over year. So that's the good, the welcome news. Beneath the surface, though, this is what they have to say. Income-based divergence in spending and wage growth persists, and we're concerned about a K-shape opening up between higher-income households and middle-income households. So not just the top and the bottom, but the middle. And that's an issue. And they offer these two stats, Lisa. So let's go through them. The gap in spending growth between higher-income and middle-income and lower-income households, the largest since mid-2022. And the wage growth gap between higher and middle-income is largest in nearly 5 years. That is a data point worthy of attention.
Yeah, and this is the reason why the sentiment surveys are not cohering with what we're seeing in the averages, because the averages smooth out some of this dispersion and make it look better than a lot of people feel that it is, especially if they're not in the upper echelons of income earning. As you look at this and you say, okay, does this scream for a rate cut? What kind of economic remedy would this actually require? And the answer is not clear, because people who are in the lower income and the middle income, if you think about it, the wage growth gap is also very high, which means that they are not seeing their pay being raised as quickly. So if you see inflation kick back up to a significant degree, guess who gets taxed the most as a result of it? It's these individuals. So if you cut rates too much and you do get some sort of reignition of inflation, they get penalized. If you don't cut rates and you don't get an acceleration in the economy, they get penalized. So exactly how are you going to remedy this situation?
They're getting squeezed. It's very difficult to do just that. Let's turn to the equity market and push this story through it. So the rotation out of mega cap tech stocks continues. Binky Chadha at Deutsche Bank is writing this. Sector funds, excluding tech, have seen a record $62 billion in inflows in the first 5 weeks of the year. That's more than they saw in all of 2025. Binky joins us now for more. Binky, good morning. Good to see you.
Good morning, John.
You track the data, you look at the flows. Do you see this as sustainable or just a knee-jerk trade to start the year? An itch to rotate?
So what I would say is basically, I think you got to put it in a little bit of context.
Please do.
So there was a fundamental driver that began the rotation, and that was really what we got from third quarter earnings, which, just as a reminder, began to get reported in the middle of October. And what you saw is, a very, very clear sign, basically, of a broadening in earnings growth. And I would emphasize that if you break it up into two, and you're looking at mega cap growth in tech and everybody else, it was not really at the expense of mega cap growth in tech. It was just really a pickup, basically, in growth for everybody else that, we've been waiting for some time, basically. Simple, metrics would be, in the second quarter, we had very respectable S&P 500 earnings growth. So, to the point that the averages can mislead, S&P 500 earnings growth was 9% in the second quarter of last year, but there were only two sectors with positive growth. That broadened to 6 in the third quarter. And for the fourth quarter, it looks like we are on track for 8 sectors with positive growth. So there is a fundamental driver of the rotation that began. And then, of course, as you fast forward to today, there are concerns about basically AI disruption. And so you're getting the negatives here, the positives here. And so, you sort of exacerbated basically the speed of the rotation. Today, we are more cyclically vulnerable because we have much greater cyclical exposure. So payrolls is important. I would say on payrolls, it's not so concerned really about the layoffs and firing that we hear about all the time. It's really an issue about the hiring rate. The hiring rate is at COVID lows. It's actually not very far above where we were at the lows in the global financial crisis. And so, you have to think about basically what is the environment that corporates face. The hiring rate did tick up late last year, the year before, after the election, and then, drop back down post-Liberation Day and hasn't really recovered from there.
There's a lot to unpack in there. I want to get into the idea that this market is more vulnerable to a downshift in the cycle because it is more heavily exposed to the cyclicals. I just wonder what's been priced in. I mean, this is an incredibly financialized market. This is incredibly driven by technicals right now as well. How much have people priced in a roaring economy of Torsten Slok versus some of the expectations that have come through based on the data points that we've gotten over the past couple of days?
Yeah, I would look at that, as we always do, which is basically through the lens of equity positioning. And I would say fundamentals-based investors, we call them discretionary investors, their positioning is, teensy little bit above neutral. So I would say no real concern there. I would say, at current absolute and relative prices, if you look at it again through the lens of positioning, what is getting priced in for mega cap growth in tech is a big down move, basically, in earnings estimates. while the facts are that earnings estimates for them are actually going up, including for software for this year, for example. For everybody else, it's kind of in line, yes. I mean, they are sort of positioned for a slowing in upward revisions to estimates, but it's a very modest amount, so I wouldn't make too much out of that.
What have you been advocating for with clients with regards to software? You mentioned that cohort of names that got hammered last week.
I mean,
what have you been saying?
I mean, our call, we do it at the sector level, so it's for all of mega cap growth in tech. We've been neutral for a while. We basically remain neutral. I'd say, the tactical case for a continued bounce from here is pretty strong, I would say. I mean, if you look at relative valuations, you look at relative positioning. Positioning in cyclicals is today comparable to the positioning in mega cap growth in tech. One is growing at close to 30%. One's growing at close to 6.5%.
Well, this to me really screams of you going into some of the big tech names that have gotten beaten up, but also the software stocks, as you're talking about that. Shopify came out with fourth quarter revenues that beat, and this is one of the stocks that was really beaten up, hammered, as a result of some of the software drawdown. Right now, you're seeing those shares up some 12.5% pre-market trading. I mean, absolutely surging as a result of what we have seen. I'm just wondering how much you think this is going to be one of the biggest outperformers and driving the market up as people reassess what that threat is coming from some of these AI tools.
Yeah, I mean, it's a threat that you cannot disprove. It's a threat that takes many, many years to basically play out. So I would argue from a tactical point of view, it's just way overdone.
Binky, it's good to see you. It always is. Thank you, sir.
Thank you.
Binky Chadha at Deutsche Bank there, bullish on this equity market. Futures doing OK, up by another 1/10% with an update on stories worldwide with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Alphabet raising almost $32 billion in debt in less than a day, underscoring the massive funding race among tech giants investing in AI. The company tapping the sterling and Swiss franc markets with record-setting corporate bond sales. Alphabet says its capital spending this year could climb to as much as $185 billion. Ford shares rising in the pre-market. The automaker saying it expects its profit to jump in 2026, despite a surprise $900 million tariff bill at the end of last year. The company plans to increase capital spending to as much as $10.5 billion. Nickel futures jumping after the world's largest mine in Indonesia was told to slash output. Sources telling us here at Bloomberg, authorities telling PT Weda Bay Nickel to cut ore production by over 70% compared to last year. Indonesia is looking to boost global prices of the country's biggest export commodity. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the programme, awaiting a Wurster-led Fed.
Kevin Warsh I've known for a dozen years. He's accomplished, he's respected, and he's been critical that the Fed has not really anchored its policy in policy rules.
We'll get into that in just a moment and look ahead to the payrolls report 50 minutes away with the former St. Louis Fed President Jim Bullard from New York City. You're watching Bloomberg TV. So this is how this morning is set up. Equities slightly positive by 1/10% on the S&P. The data just around the corner. Let's call it 44 minutes away. The payrolls report, the delayed payrolls report from January, remember. The estimate, the median in our survey, about 65,000. In the bond market, yields just off the lowest levels of the year at 4.13 on 10s, down about a basis point on a 10-year maturity. Just about unchanged at the front end of the curve at 3.45. Had a repricing at the very front end of the curve off the back of this weaker than expected data, which makes us vulnerable, of course, to better than expected data in about 40 minutes, so look out for that. I want to get you up to speed as well on some headlines that's coming from an interview with the Ukrainian leader, President Zelensky, saying a deal on territory is in focus for the next round of talks with the US, and saying that Ukraine is ready to meet in the United States next Tuesday or Wednesday, and it's unclear if Russia agrees to meet.
Yeah, and this is the ongoing negotiation, a real question of whether they can get some sort of peace deal. We'll get more details as this comes out. What Zelensky said in a phone interview in Kiev on Tuesday, none of the sides is keen on the idea of the free economic zone, neither the Russians nor us. We have different views on it, and agreements were as follows. Let's come back with the vision of what it may look like for the next meeting. So that potentially is what's on the table.
Let's see if we can make some progress in the next week or so. Let's turn it back to the data and, of course, to the Federal Reserve under surveillance this morning, awaiting a Walsh-led Fed.
Kevin Warsh, I've known for a dozen years. He's accomplished, he's respected, and he's been critical that the Fed has not really anchored its policy in policy rules. Kevin Warsh will have to work with the committee and will have to bring the committee along with him if he wants to make the changes that he says he wants to make. The chair has the power of persuasion, but at the end of the day, he or she only has one vote.
So here's the latest this morning. Traders weighing the future of monetary policy under a Federal Reserve chaired by Kevin Warsh. The former St. Louis Fed President Jim Bullard joins us now for more to talk about that and, of course, the payrolls report just around the corner. Jim, welcome back to the programme, sir. A Warsh-led Federal Reserve. What changes should we be anticipating?
I know Kevin Warsh well. I think he'll do a good job. He has been a critic of balance sheet policy. For those that don't recall, in 2010, he was an opponent of the second round of quantitative easing. And actually, the day after the vote, he put out a op-ed outlining his objections. And about 6 months later, he left the Fed. So he felt very strongly about that issue. He felt that the Fed was straying into fiscal policy, something that has been debated at the FOMC ever since. And now he'll have a chance to bring that vision into play.
So, Jim, you didn't hide your feelings about the communication architecture coming out of the GFC, the dot plot, for instance. Is that something you'd advocate to ultimately get rid of?
I think it's time for a reform of the dot plot. The committee hasn't found a way to do that, but I think with an incoming chair, now would be a good time to look at it. Former Chair Ben Bernanke put out some suggestions last spring, and maybe those could be the basis for a compromise on the committee.
This does seem like a pivotal point. I mean, we're sort of at a tipping point in the economy potentially, but there is no real need for the Federal Reserve to react. There's a question about later this year. If Torsten Slok of Apollo is correct, we do get some sort of reacceleration, what the reaction function will be from a Warsh Federal Reserve. If we do see inflation really remain sticky or even tick upward, do you have confidence based on your understanding of how he was back in the earlier tenure when you worked alongside him, of what his reaction function would be?
I think he'll be very careful and cautious. He certainly does not want to reignite inflation in the U.S., and I think he'd be very careful on that issue. The committee has already come down 75 basis points. I think the attitude on the committee seems to be that now they can wait and see. A lot of the news, maybe not the very most recent news, but the basic news on the economy has been for a booming economy in 2026. And if that's the case, the Fed probably won't see the need to do too much more.
Part of the problem, Jim, and we were just talking about this, about the K-shaped economy based on the Bank of America credit card data showing just how much that K has widened, not just with the upper class and the lower class, the upper class and the middle class. I'm just wondering how rate cuts fit into that. If you have a structural problem where you do see a number of people being left behind in both the employment level as well as just wage growth, how do rate cuts target that? Do they make it better or do they make it worse?
Well, the sad truth is rate cuts probably, don't do too much about that because that affects everybody in the whole economy, not just in the U.S., but across the world. So it's hard to talk about something that's targeted to a specific group. That's really the role of fiscal policy. And that's something Kevin Warsh has emphasized. You want to make a good monetary policy for the U.S. and by extension for the rest of the world, and then let the fiscal policymakers, work their magic through the democratic process and try to come up with various programs to help certain segments of society.
Jim, Governor Waller's talked about the headline number, not just the disparity beneath, and that's a man you worked alongside, of course, at the St. Louis Fed. I'd love your view on this statement that he put out after he dissented to the last decision to keep rates unchanged. The recent data, quote, indicates to me that there is considerable doubt about future employment growth and suggests that a substantial deterioration in the labour market is a significant risk. Do you think the Fed has done enough already to insulate against that risk?
Yeah, my judgment would be that the committee took that argument on board. They made the moves that they wanted to make, and now they want to hold where they are because inflation is still above target. Also, I think the non-farm payrolls number is, as you guys have discussed extensively, is very hard to interpret right now because of the change in immigration policy. It's a sharp change in immigration policy compared to where we were. So you might want to look at the unemployment rate instead, and that's always been a major indicator, of course, for the Fed, but it's only 4.4%. So that is actually pretty close to the natural rate of unemployment, according to most estimates for the U.S. economy. So you might say, well, the labor market, based on that, looks pretty good. We already took out some insurance against the possible deterioration. And we've still got inflation above target. So I think that's basically where the committee's coming down.
Jim, there's a lot of discussion about what the Fed should do and then what the Fed will do. And that's where the politics comes into play and this question of how much the political overlay and the demands to get the economy really hot, 15% growth rates, come into play. How do you see that at a time where increasingly central banks are political, just in part due to the fiscal overhang, the deficit that increasingly is tied? So you've got the interest payments that are tied to what the Federal Reserve does. I mean, how realistic do you see that threat?
Well, the Fed, of course, these are political appointees on the Board of Governors and not political appointees at the Federal Reserve banks. And the art of this is to pull these decisions a little bit away from the day-to-day fray of politics inside the Beltway and try to make decisions for the medium term and the long run. That's been, by and large, very successful over the last 100 years. And when Congress has looked at this in the past about possibility of changing it one way or another, they've always come to the conclusion that they like it the way it is. So, I don't think we should think about totally independent Federal Reserve. That would sound like you don't have enough accountability, but you don't want the decisions being made directly by the banking committees or the Financial Services Committee or inside the White House. So the art is to get this a little bit away from the day-to-day politics, and I think that's the way it's going to stay. Because Congress has looked at this many, many times, and they've come to the conclusion that they like it the way it is.
Hey, Jim, it's good to see you. As always, thank you, sir. The former St. Louis Fed President, Jim Bullard, weighing in on the Federal Reserve future leadership and the jobs report just around the corner. 35 minutes away. You've got headline numbers that matter to markets and the disparity beneath, which really matter to the electorate and ultimately will matter to the future of the politicians in office right now. The wage growth gap between higher and middle income is the largest in nearly 5 years. That data coming from Bank of America. The gap in spending growth between higher income and middle income and lower income households, the largest since mid-2022.
This belies some of the averages and speaks to the consumer sentiment surveys that run in contrast to the earnings and the market performance.
The headline data, card spending up 2.6%, still looks pretty good.
Everything looks rosy.
The details still problematic. Coming up on the programme, we'll catch up with the Charles Schwab president and CEO Rick Wurster and a whole lot more. The third hour of Bloomberg Surveillance just around the corner.
This is not an economy that requires a significant amount of job growth behind it.
Jobs is a challenge, as I think wage growth will be a challenge.
We're not concerned we're going to see a spike in the unemployment rate.
The labor market is softer than what might have appeared up till now.
I don't know if the market's ready for seeing a negative print.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and the jobs report is 30 minutes away. Equity futures on the S&P 500 positive by about 0.1%. Likewise on the Nasdaq. Bond yields very close to the lows of the year. On a 10-year, we're down another basis point, down every single day this week so far. 413.28 is where we are on a 10-year maturity. 30 minutes away, the jobs report, delayed, of course, about a week. The payrolls report and the estimate we're looking for. The median estimate in our survey, about 65K.
Yeah, and a 4.4% unemployment rate, which would be holding steady from the prior read. This wouldn't be a terrible reading compared to what we've seen from Stephen Englander, talking about negative 10,000 jobs and a potential downward revision to the household survey that also comes out today. A real question is how offsides will this market be to either a bad print or now a good print, based on how much bad news has already been priced in the past couple of trading sessions.
We've discussed it extensively throughout this morning, that this market is now more sensitive to incoming economic data in a way that it wasn't in the previous 12 months, given the shift in leadership. Last year, it's big tech. Big tech and those stock stories immune to the payrolls data. This year, it's about the cyclical parts of the market and small caps. You need the economy to perform it well to justify that rotation.
Yeah, make payrolls numbers great again. That's sort of where we're at, except there's a little bit of a problem, which is how do we understand those data? How do we understand exactly what we are seeing in the underlying economy as we get data points like the one at Bank of America that show huge dispersion in wage growth, huge dispersion in job opportunity, huge dispersion in spending capabilities. And so you look at the average and you say, what do I do with that? And that's the reason why people are saying be a stock picker and take a look at which companies are benefiting and which are not.
You're going to see the market trade the headline and the politicians suffer from the disparity. And they're going to introduce the remedies that actually might make it a problem for Wall Street. And that was the early signs that we started to see at the start of this year when the president came out and started talking about interest rate caps and those kind of things. Gone away a little bit now, but no doubt we'll be back on the table the closer we get to the midterms.
Yeah, and then there's, of course, the big question of how much of a constraint does this put on some of the electricity usage of the big tech players, considering that electricity costs are going up. This is a reason why policy volatility is named as one of the top risks for this year, according to a recent JP Morgan survey, because ultimately this disparity gets closed through fiscal response, and that means politics, and that means this is the reason why we pay attention to every truth and every policy proposal coming out of Washington.
Those surveys
DC.
do bug me sometimes, though. You know, when it's like their top risk is uncertainty. They're like, uncertainty is my top risk. That's what I'm worried about. I'm worried about uncertainty.
Yeah, my top risk is, I don't know.
Do you know what I mean?
It's sort of outsourcing it.
Like every other year, you had a fortune teller who told you everything was going to be okay, but this year you're worried about uncertainty.
This year, it's a black swan. Literally,
Right?
it is
Come
a
on.
black swan that could come to my dress.
Big hour coming up. Schwab CEO Rick Wurster joins us as AI fears send wealth manager stocks falling. We'll also catch up with the U.S. Interior Secretary Doug Burgum as the country prepares for major changes to climate policy, and Mike Gapen of Morgan Stanley reacting to the payrolls report. We begin this hour following a tough session for wealth management stocks as a little-known tech startup Altruist unveiled a new tool aimed at creating tax planning strategies, sparking a sell-off across the industry. We're joined now by one of the companies under the spotlight in the last 24 hours, the president and CEO of Charles Schwab. Rick Wurster joins us now for more. Rick, welcome to the program. I just want you, if you can, to take us behind the scenes. When you see your stock falling 5, 6, 7%, and you're sitting there looking at the Bloomberg terminal, Bloomberg.com, wherever you look, I hope you go there, and you say to your team, why are the stocks falling? What's happening to our name? Rick, how did you respond just yesterday with the management team?
Well, I did look on my Bloomberg terminal. I've been a user for a long time, and so trying to understand what was happening. You know, for us, AI is a real accelerant. So it was puzzling to see our stock sell off related to AI because we're benefiting from it in multiple ways and bringing it to our clients to help them in their financial lives. And we think we're best positioned in the financial services industry to help clients with AI because of our size, our scale, the depth of our relationships, and all the data we have, which is a key ingredient to winning in AI. And I'll share an example. You know, last week, we brought the best of people and technology to our clients. We had a family come in that had a complex trust. They wanted to have a discussion with their children about what that trust meant, how it was going to help them in the future. But it was a 400-page document and hard for the kids to understand. And using wealth.com, which is a tool that we have available for our clients, they were able to create a 2-page visual summary of their trust and estate document that led to a conversation with their advisors and their trust experts that brought a lot of light to what was in that plan and put the whole family on the same page. And that power of people and technology, I think, is what will win in the wealth space. And we think we're the winner on both fronts, which is why we were disappointed and surprised to see our stock sell off yesterday.
So, Rick, let's talk about the people selling and ultimately why they sold, because in their minds, you've got this company, this small startup that's going to automate personalized tax strategies and make it much cheaper and threaten your pricing power and the pricing power of wealth managers more broadly. What are they getting wrong?
Well, I think that AI tools like tax planning, which we have available today, is something that's going to make advisors more effective, more consistent, able to serve more clients, but it's not going to make them less useful. Ultimately, what the client is looking for is convenience and expertise. And the advisors are going to continue to play a critical role in bringing together all the AI tools, all the right information to have that discussion with the client. They're going to lean into relationships. They're going to lean into judgment. Ultimately, these are complicated decisions, very emotional decisions that often involve family dynamics. And that role of the advisor as a critical sounding board to the individual and to the families, we don't think that's going away, but we think AI will make those conversations more impactful and more powerful.
So, Rick, I don't think market participants think it's going away wholesale either. I think what they think is going to lead to fee compression and a shift in market share. And ultimately, Rick, that's the difficulty that you've got now. It's the difficulty proving the negative, that won't happen. How do you go about doing that in the year ahead?
You know, this is the same story from 10 years ago when robo-advice was going to displace the advisor community and pressure fees. And if you look at what's happened, first of all, I think we're the biggest robo-advisor in the industry. We have $100 billion of assets. And we've provided that technology to our advisors who have used it to be more efficient in delivering for their clients. But you haven't seen it displace the growth of the advisor community. In fact, it's grown and fees haven't come down. And that, again, that was a new technology 10 years ago. It's been additive to the advisor community, just as I think AI will be. And so I don't see fee pressure. I actually see this accelerating the importance of the role of the advisor, who's going to have to work and bring all these AI tools together and all the different insights and make them impactful for the client.
Rick, there's a larger question here, especially on payrolls Wednesday, which is, I guess, where we're at, which is in order to justify the fees and the business model, do you need to hire higher caliber people, but many fewer of them? In other words, a lot of these other smaller tasks can be done by artificial intelligence, by some of the robo-advisory programs that you already have in place. Have you already seen that come to your business model?
We're seeing AI help our clients in multiple ways. One, it's bringing new tools and capabilities like the tax, trust, and estate capabilities that we're using wealth.com that I described earlier. It's allowing us to reach new clients. And I think that's why you won't see the population of advisors shrink, is that AI will be useful in reaching new clients that we couldn't before. I watched a client interaction in our agentic AI capability pilot that we're using with clients that we built in partnership with a leading AI firm just this week. And what that tool is able to do is have a direct dialogue with the client digitally that understood what the client wanted and needed. And then after having a tactical conversation, ask the client, this agentic AI, say, can I call you and have a broader discussion about your financial goals and plans? And this agentic capability was able to have a conversation about his desire to put his 2 kids through college, to be able to travel in retirement, and ultimately to leave a legacy to his family. And then that led to a conversation about a concentrated position he had, and maybe the need for him to talk to one of our experts about using a tax loss harvesting strategy to diversify that position. Those are conversations that at the scale of 46 million clients we couldn't have before. But now with the power of AI, not only are we reaching those clients that we have a relationship with, but we're able to help a whole new group of clients that we couldn't before. So AI is going to be powerful for our industry. We're going to be the natural winner because of the depth of our relationship, our client base, our technology, and the data. And we're leaning into this trend in a significant way because we do think it's going to be big.
It sounds like a lot of what Brian Moynihan of Bank of America said, which is that the entire business size would grow tremendously and the size of the employees might not change, but the ability to capture a larger share of the market does increase. How much do you find, Rick, that you have to invest in some of the technology, that you have to do different CapEx plans in order to keep up and make sure you're not left behind?
Well, we're investing a lot, but Lisa, I'll come back to the benefits. We look over the last 5 years in which when we have been investing heavily in our efficiency and leveraging AI to do so, Our cost to serve an account has come down 21%. On an inflation-adjusted basis, that's 40%. Our headcount isn't any lower, but we've grown and we've used technology and AI to be more efficient, to serve clients in different ways, to answer their questions more efficiently, to do more digitally. All of that is leading to cost efficiencies for our business, but it hasn't meant lower headcount.
Rick, if you could point to one thing, what do you think is your biggest moat right now?
I think the size and scale of our firm and the fact that we keep the clients at the very forefront of everything that we do. For 51 years, we've been about client choice and innovation and technology. If a client wants to work completely with a robo-advisor or an AI advisor in the future, we're going to have those capabilities and we're going to make it available to the advisors on our platform. But I think most are going to work with the combination of people and technology because these are emotional decisions where that combination is going to be really powerful. And we're going to make that available to our advisors and to our clients. So I think our biggest moat is that we always put the client first. We innovate, we adapt, and we move forward to make them as best off in their financial life as they can be.
And Rick, just as a final question, just to speak to you as a human being, you wanted to make this appearance happen today, and we certainly welcomed it. I always enjoy catching up with you. Was there something about yesterday that just kind of pissed you off as a man, as a leader of a company, that made you want to engage a little bit more?
Well, I think there's two things. Number one, I think the market's missing that we are a natural winner in the AI space because of all the advantages we have, because of our size, our scale, our data. And so I think it's important for the market to understand that and see us as an AI company. Number two, we've seen what's happened in some of the other spaces like software, and we wanted to be able to come on and tell our story about why we're so much different and why AI is a beneficial to our business, not a hindrance, and it's going to help us flourish and grow and serve clients in new ways and ultimately lead to the growth of the company.
We saw this with software names last week, and what I didn't hear much of was insider buying. Now, Lisa and I were just talking about this, Rick, and we're wondering whether you saw the move and you stepped in.
Well, I own a lot of the stock. I love the stock. If I'm allowed to, I'd tell anyone to buy it where it is today. I think we've got tremendous upside. If you look at our earnings last year and our revenue, we hit all-time highs. In our winter business update this year, we guided to or presented a scenario that would lead to earnings of $5.70 to $5.80. 2027 looks very bright. We've got so much going for us, and AI is only going to accelerate our ability to deliver for clients and grow our firm. So I couldn't be more bullish about where we are and where the stock is.
Rick, thanks for making this happen today. We appreciate your time. Thank you, sir. We'll do it again soon. Rick Wurster there, the Schwab president and CEO, on some of the competition they face now, particularly with the moves of the last day or so.
Look, clearly he's fired up. Clearly he wants to defend the business model.
Without a doubt.
And he's showing how it can actually be a beneficial attribute for them. At the same time, they're facing off with an existential threat that is undefinable because we don't understand how far some of this technology is going to go, which explains the move. A real question of how this is going to shake out. The point that Brian Moynihan made is really important. These are companies with much bigger businesses and smaller footprints in the employment side of things. And that's what he's talking about, too. Essentially, it's staying the same size, but their business is growing and consolidating share across the industry.
It's hard to prove the negative. It was the takeaway with the software story last week, and it's the takeaway from the wealth management shakeout you've seen in the last 24 hours. It's really difficult to come out and craft a message that proves the negative.
It's like a high school rumor. When someone goes around and saying, I didn't say that, I didn't do that, everyone's thinking like, of course, and that's what happens. And it's a similar kind of feel right now. It's kind of like a high school playground.
The future's doing better. Is that how you describe the market? Used to be toddlers, right? And now it's a high school playground.
We've grown up.
I know. Good for us. We're up about 0.1% on the NASDAQ 100, on the S&P up by 0.12%. Going into payrolls about 16 minutes away with an update on everything else happening in the world with your Bloomberg brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Ukraine's President Volodymyr Zelensky says he's accepted a U.S. offer to host another round of talks to end the war with Russia. Zelensky telling us here at Bloomberg that the next stage of talks will zero in on the issue of territory. He also said that the war could end within months if the talks proceed in good faith, and Ukraine needs to approve a final proposal. Kraft Heinz shares are lower in the pre-market, the company announcing it's pausing its planned breakup into separate companies as the new CEO, Steve Callan, focuses on improving results. Callan says his number one priority is returning the business to profitable growth. So far this year, shares have risen just over 2.5%. Nike's turnaround plan apparently in full swing. CEO Elliott Hill sitting down with Bloomberg News at the Olympic Winter Games in Milan.
The portfolio that we have, 3 strong brands, Nike, Converse, and Jordan.
Yeah.
The focus on sport and how we're segmenting each of the brands by sport, and then ultimately paying it off in 190 countries around the world is only Nike can do at the size and scale that we are.
Hill and the leadership team at Nike aiming apparently to reverse the company's performance. Shares are down more than 11% over the last year. And that is your Bloomberg Brief. John.
Ivani, thank you. Up next, we'll get you some morning calls. Plus, we'll catch up with the Interior Secretary, Doug Burgum, with major changes coming to U.S. energy policy. That conversation up next, live from New York City this morning. Good morning.
The rotation's been going in the direction that most investors wanted it to be going, to be honest with you. Since probably November, people have been kind of selling large cap growth and kind of rotating into value, and particularly into cyclicals, because anticipation of the stimulus and a strong U.S. economy. So we think there's space to go there.
Stuart Kaiser of Citi weighing in on this market. Equities look like this morning, up by 0.1% on the S&P. Likewise on the Nasdaq, a similar move on the Russell. That's the price action. Let's get you some morning calls. First up, from Bernstein, raising its price target on Apple to 340, highlighting Apple Intelligence as the, quote, big story. Your second call from Wells Fargo, cutting its price target on Lyft to 18, warning of share loss concerns ahead of an autonomous vehicle debut. And finally, Citi downgrading Mattel to neutral, saying the toy industry is becoming a story of haves and have-nots. Check out that move this morning. Mattel in the pre-market down by 28%. There's some of the morning calls this morning. Let's turn to energy and critical minerals. The Trump administration set to announce a major shift in climate rules, rolling back an Obama-era policy regulating fossil fuels. On that and more, the U.S. Interior Secretary Doug Burgum joins us now for more. Mr. Secretary, you have been a busy man over the last week. I actually want to start with Project Volt, and then we'll get to the EPA and what's going to happen with regulations around fossil fuels and such. Mr. Secretary, what is Project Volt, and how should I be thinking about this in comparison to, say, the SPR?
Well, it's absolutely a comparison. The Strategic Petroleum Reserve has created a great buffer on price shocks for American consumers for decades and decades. We have no equivalent on critical minerals. There are 60 minerals on the critical minerals list. Some of those are rare earth elements. China, as you know, Jonathan, controls about 85 to 100% of the processing and refining on about 20 of those, enough to put a stranglehold on global industry, whether it's tech, high tech, whether it's defense, whether it's consumer. And so with the threats last year put out by China on export controls, the U.S. leapt into action. We're broadly bringing mining back in America, but this idea of creating a strategic critical minerals reserve across 60 different elements, driven by the private sector, great leadership by across the board of multiple cabinet secretaries in the Trump administration, working with the Ex-Im Bank, working with the private sector, about $10 billion in a loan, about $2 billion in equity capital going in. This is going to be private sector funded, market driven, and those critical minerals will be stored at locations that are economically smart and economically efficient around the country. But the idea is that we will, in addition to that, last week there was also at the State Department a historic meeting. Over 50 countries came to the U.S. All of them, some of them already signed on, many others interested, joining a club of nations with free trade on critical minerals with price floors. The key on price floors is that it would block China from illegal dumping to kill the price across any one particular critical mineral. And that's going to allow the assurance for capital to start flowing back into mining and refining of these minerals in the U.S. and in our allies. So tremendous interest from the leaders, ministers from around the country that were there at the event hosted at the State Department last week. So anyway, great progress going to make sure that U.S. is secure relative to our position on critical minerals.
And Mr. Secretary, you certainly alluded to it. China's got a stranglehold over critical minerals, and America needs to do something about it. And overwhelmingly, there's agreement on this program, often almost weekly, to do something about it. What is less understood is why they have that stranglehold. You talked about pricing and dumping. What about regulations? This is typically quite a dirty process. Has that held back production domestically as well?
Well, there's been an attack on American energy in this country, but even longer than that, there's been an attack on mining in our country. And just like President Trump says, drill, baby, drill, we've got to get back to mine, baby, mine. The U.S. graduated 36,000 lawyers last year and about 300 people with mining and metallurgical degrees. China, of course, is not doing it cleaner than anyone else. I mean, whether they're tearing up the Congo or Indonesia, child labor, illegal cartels, criminal organizations, all of these things that are going on. It's a dirty industry potentially for the environment, but there's a lot of corruption around that, in part because countries like America or like those in Europe that have rules, that have EPAs that can do things cleaner, better, safer, smarter, both in terms of the environment, in terms of the labor force, basically got out of this business. And we've got to get, the free world's got to get back into the mining business and show that with innovation that we can do it, and we can do it in a way that protects the environment, protects the workers, and also then protects the economies of these countries. And so this is a strategic importance for the United States to get back in. And part of that is the permitting process. We've put a stranglehold on permitting, but for President Trump, we're breaking the logjam on permitting. Big announcements coming around the endangerment finding, and this is going to be a huge step forward in terms of getting projects done and keeping plants open in America.
Mr. Secretary, there's a question around refining things like lithium that are crucial for a lot of the high-tech aspects that go into our economy. There's a question about copper, really necessary for the build-out of some of the hyperscalers in particular. On the other side, there are things like coal, and there's a real question of some of the rollbacks, the EPA rules, like lowering emission standards as well as potentially increasing the use of coal. Why are those necessary to get some of the national security goals that you're talking about?
Well, we'll be making some more announcements on beautiful, clean coal today, as President Trump likes to call it and should call it, because there's a coal plant running in America today. It has survived an onslaught for 20 years. But they've taken everything, virtually everything out of the NOx, the SOx, anything that would be considered an issue relative to the environment. And what's left, the attack on coal as a baseload power, has been largely around CO2 emissions, and with the reversal of the endangerment finding that says that this was massive overreach by the Obama EPA, that we are going to go back to a thing where we can have consumer choice, that's lower prices. And of course, with the big storms we had in the Northeast last week, I mean, check back on Secretary Wright's press conference last Friday, but we would have had millions and millions of people in this country without power if coal hadn't stepped up. Coal was the hero of keeping the lights and the heat on in America, and all of the money that has been spent in the northeastern part of this country on renewables. There was times during those storms where we had less than 2% of the power coming from wind and solar. There was more coming from burning wood and trash than there was coming from wind and solar, and coal in some parts of the country was providing 25% of the electricity. So we need the Biden plan of energy transition was actually energy subtraction. It wasn't addition, it wasn't transition, it was subtraction. They were shutting down base load and then replacing it with intermittent, unreliable, foreign-sourced forms of energy that required us to build out all kinds of additional infrastructure on top of the infrastructure we already had. That's what drove up prices. And now we're facing this AI arms race with China. We need more power. We need energy addition. The way to have energy addition is to stop getting rid of the stuff that already works. And of course, that includes our fossil fuel baseload. In the PGM market, 70% of the power was coming from hydrocarbons, during those storms. I mean, America and the world is dependent on it and is going to be for in the long future. Innovation is what we need to help solve any concerns that people might have about future climate change.
Mr. Secretary, a lot of people could get on board with that. The problem is that a lot of people have pointed out that it feels like there are certain energy sources that have gotten subtracted in this administration as well, wind being among them, that it's not necessarily that we want all energy sources, but picking winners and losers. How do you counter that?
Well, it's easy because we're not picking winners and losers. We're picking reliable, affordable, nationally secure sources that can provide what Americans need, what we need for low prices for consumers, what we need for industry, and what we need for AI. What we're not subsidizing any longer is intermittent, weather-dependent, foreign-sourced, which in the case of offshore wind hits all three of those, but it's also the highest cost. It's not affordable, and it's also opposed by our marine fisheries. I was meeting with a group of third and fourth generation fishermen in New England last Friday. It's blowing up their business. These are the farmers of the sea that put food on our table. You meet with the marine mammal groups, the Save the Whale groups. They're opposed to offshore. National security now, there's a classified reports out that the radar interference above the water and the sonar interference below the water of these massive offshore projects represent real national security risks. These are not made up things. These are things that have to be considered, particularly related to offshore. But with the working families tax cut bill that got passed last July, people are not contemplating new projects. We have companies that are coming to us from around the world that are saying, hey, we're not going to be building offshore because we get it. It was only viable because of the massive tax subsidies. So Americans had to pay twice. They had to pay in terms of higher electric costs, and then they also had to pay through these tax subsidies. So it's all of the above that are reliable, affordable, and dispatchable, and don't require massive subsidies. I mean, and that's the level playing field that we're at right now.
Mr. Secretary, just quickly, because people will hate us if we're talking about wind farms when payrolls comes out in about 60 seconds' time, but I want to squeeze this in. Courts, as you know, have ruled against your administration's stop work orders on these offshore wind farms. Are you going to appeal that?
Absolutely, we are. And as I'm sure as we get into court and have sessions and share classified information, there will be further discussions on this. People are saying that, oh, this is some ideological attack on offshore wind. No, this is like a real, genuine concern. And as Americans, we should be concerned. No one's reading a story about pilots getting shot down in the Iran or in the Russian-Ukraine war because everything is autonomous. It's autonomous on autonomous. And if you've got massive radar interference just off our huge population centers, if you wanted to attack America, you would launch autonomous drones through those things, or you'd launch autonomous submarines because of the sonar interference. And so we just have to wake up. Warfare has changed in the last 4 years. The world's different, and we have to be ready to respond to it.
Mr. Secretary, we'll talk another time a little bit more about this, no doubt. Thank you, sir. The U.S. Interior Secretary, Doug Burgum there. I promised that we wouldn't be talking about wind farms when payrolls comes out. Payrolls is out in about 8 seconds' time. Equity futures on the S&P 500, firmer here by about 1/10% on the S&P. On the Nasdaq 100, up by 1/10. On the Russell, up by 0.2. The jobs number we're looking for in our survey, the median estimate 65K. We have got a nice big upside surprise, 130. That is 130,000 payrolls. The estimate in our survey was 65. To work through the rest of the report, looking at monthly earnings, average hourly earnings month on month, that comes in at 0.4. That is also an upside surprise. The estimate in our survey was 0.3. And this is the right kind of downside surprise. The unemployment rate coming in at 4.3. The estimate was 4.4. So going through this, just data point by data point, a high-level read on things, upside surprise on payrolls, wages just a little bit hotter month on month, and the unemployment rate lower than expected at 4.3% against an estimate of 4.4. The outperformance in the equity market, guess where that comes? It comes from the Russell. Russell 2000 futures outperforming off the back of this. Let's push it through the equity market. On the S&P, on the Nasdaq, on the small cap so far this morning. The S&P up by 0.3. Likewise on the Nasdaq, there's your outperformance up by 0.6 on the Russell. In the bond market, yields have been drifting lower over the last few days off the back of weaker than expected economic data. Off the back of that, yields higher by 5 basis points on 10s, and at the front end of the curve, 2s up by 9. We can get to the benchmark revisions in just a moment. We were expecting some big numbers. I can tell you we've got some big numbers, but so far, just to focus on this jobs report, that jobs report, better than expected.
That sound you hear is a huge market that is pricing out rate cuts anytime soon, because ultimately people are saying this and maybe dismissing some of the data that we got yesterday. 2-year yields surging up more than 7 basis points, which gives you a sense of how much people are repricing. How much was that a head fake that we got yesterday in terms of retail sales and consumer delinquencies? 4.3%. The fact that the unemployment rate went down was not in a lot of people's bingo cards.
The dollar stronger off the back of this as well. Euro dollar down by about 1/3 of 1%. Euro dollar right now, 118.55. So a few things were happening this morning. One was the jobs report, and the other was the annual benchmark revisions, and that subtracted 862,000 jobs. That's not a typo. 862,000 jobs subtracted. The estimate was negative 825,000. So I'd say that's roughly in line with expectations, as dramatic as it is. The story this morning, though, is the bounce back we're seeing in payrolls for January, and whether that's going to continue, given what's been happening in the equity market and the vicious rotation we've seen into more cyclical parts of stocks.
Especially because the outperformance in the headline number really came from private payrolls. If you take a look at the private payrolls number, that was 172,000 versus the expected 68,000. That is more than twice as much as what we were expecting in terms of what Wall Street analysts had penciled in. This just shows, this does point to robust growth, even with 17,000 jobs taken off the 2-month average in terms of what the revisions were. So if you take a look at the bigger picture, this seems to weigh in on the everything's just okay front rather than, the sky might be falling in a couple months' time.
Don't panic, Kevin Hassett said. No one's panicking looking at that.
Honestly,
is it fair to say Kevin hadn't seen the numbers?
I think that's the takeaway, is that the people who came out talking about potentially seeing lower numbers had not seen these numbers, and this is confirmation right here.
Enda Karen joins us now from Washington, D.C. to break down some of this. So, Enda, let's start with the jobs report for January, and then we can get to the benchmark revisions. What's your reaction to that?
Face value, it's a very strong number, John, like you were just mentioning there, 130,000 on the month, much stronger than expected. And within the details, some strong numbers. Look at manufacturing, adding, I think it was 5,000 jobs. That's a big turnaround from the manufacturing story of last year. The unemployment rate falling as well, that's unexpected. And the private sector seems to be driving the job story because the government continues to lose staff, looking at the headlines coming out from the data so far. So, as I say, face value, first reaction, these numbers lend themselves to, at the very least, the stabilising jobs market that the Fed were talking about a few weeks ago.
And you've heard the pushback multiple times. It'll be no different this morning. People will say there's narrow breadth here. Most of this is healthcare. They'll also say, look at the benchmark revisions. All of this will just get revised away in the year ahead. Are they wrong?
Well, the benchmark revisions are notable. They've obviously come in a little bit better than expected, Jonathan, coming in with an 8 handle rather than the 9 handle. So that's not insignificant. I think, though, in terms of policy-making world, they're already ahead of the curve on that. They would have anticipated, given the preliminary revisions that we had, that the jobs market would be that much weaker last year anyway. So to some extent, that story is baked into the cake. But there's no doubt about it that, and that's what I said earlier, at face value, the January figures are strong. But of course, there will be a revision story, not just on a month-by-month basis, but again, when we get to the end of the year, some of this will be recalculated. But right here, right now, you'd have to say that January number at least suggests a healthier jobs market than a lot of people were expecting.
Enda Karen with the latest down in Washington. Enda, thank you. If you're just joining us, welcome to the programme. A decent surprise, a welcome surprise. Let's go through the data together and then we'll turn to stocks, bonds and foreign exchange. In the jobs data, an upside surprise, the headline number 130. The median SMNR survey was 65. That's strong. You turn to wages, that comes in just a little bit hotter than expected month over month on hourly earnings. Month over month, that comes in at 0.4. The estimate was 0.3. Downward revision to the previous month. Keep that in mind. The unemployment rate drops to 4.3. We were looking for 4.4. So at first look, you look at that and you're like, OK, let me go to the equity market. And I think small caps are outperforming, and they are. They're up by almost 1% as this market continues to drift towards the more cyclical parts of the equity market. An endorsement from the data this morning, which goes against the grain of the last few days. Weaker than expected retail sales, jobless claims, challenger job cuts, jolts, all of that stuff. Feels like a distant memory all over again. All of a sudden, people are like, yes, I knew this was going to happen. Look at the ISM manufacturing. That was great. It all makes sense. It all makes sense now, doesn't it? Turn to the bond market. 2s, 10s and 30-year bond yields are drifting higher. 2-year bond yields up by 8 basis points. So up 8 basis points at the front end of the curve. 10-year yields up 5 to 4.19. It's a repricing of the curve, particularly at the front end, which, of course, is more sensitive to interest rate reductions or hikes over at the Federal Reserve and Fed policy more broadly. And the idea that we're going to cut is going to get pushed out. And Torsten Snock of Apollo is probably feeling better about himself and this conversation about rate hikes by year end.
Look, it's up by 3 basis points. I told you they were too low, those 10-year yields. Look, ultimately what you are seeing in markets is now less than a 20% chance of a rate cut priced in by March, and then really ongoing, just removing that chance throughout the remainder of the year, partly because it does seem like the labor market is not cracking. That said, and this is actually a comment from a Bloomberg user, which I think is a really interesting one, which is annual benchmark revisions, updated birth death model, and new seasonal factors. It's apples to oranges comparisons. What data are we actually looking at? I mean, look, ultimately, the market is taking this at face value, and I am too, because ultimately it's a good sign to see that there is job creation, particularly in the private sector. On the flip side, how do you get some sort of longer trajectory look based on all of the revisions, the seasonal, everything that's been going on?
Good luck, Mike Gapen. He joins us now. Michael Gapen at Morgan Stanley. Mike, good to see you. Welcome to the programme.
It's all clear now, isn't it?
If I was calling you as a client, my first question would be, Mike, how much confidence can I have in this? Is this the real deal?
I think it's largely the real deal. Everything that you mentioned is completely fair. Benchmark revisions, new birth death adjustment. There's favorable seasonal factors in this report. But does it wipe away 170,000 private payrolls? Probably not. I mean, we were at 90,000 on private payrolls, and I felt optimistic, right? So if truth is 90, I'm super happy with that number, right? So at 170, I think it's hard to bring all of that back and look through it. So and to your point, it does fit a lot of other data points in the economy. Durable goods have been strong. ISM has picked up. Manufacturing output has been on an upward trend. So seeing some complementary hiring alongside that is a welcome sign for the economy.
Do you think focusing on December retail sales like we were yesterday is a waste of time? Are you expecting a bounce back? Should we just see that as a head fake?
I think we will see some bounce back, but not entirely. There is softness in that report. But just remember, even in what I'll call normal times, retail sales is very volatile, gets revised frequently. So the signal out of retail sales, I think, is always kind of maybe second order. I think the market puts more weight on it than it otherwise should. But look, even with that number, consumption is likely to come in at around 2.3% in the fourth quarter. Still a solid number with a weak December retail sales.
Are these good jobs that are being created? Do we have a sense of the quality of them?
Well, I haven't seen the mix, but I think the average hourly earnings number at 0.4 suggests that there are quality jobs on that front. That's an average number across all the sectors. So I think any job is better than no job. So I certainly think there's quality in it, yes.
I guess that I'm looking at, for example, 124,000 created in health and social assistance, private education, 137. I mean, some of the main winners have really come from a couple of sectors that are sort of independent of the cycle. It's that we're getting older and that we're paying a lot of money for our kids to go to college. I mean, how much can we glean strength from these numbers and a sense of sustainability?
Well, the narrowness of job gains has always been the question. The narrowness of growth in the economy has always been an issue. It's spending by upper income consumers. It's AI-related business spending. Our thesis is that you will see some broadening out in 2026. So as you mentioned, the rebound in small caps, we do think that if you get a stabilization in the labor market, inflation does come down, it can support purchasing power of other parts of the economy, and the economy can broaden out. But so the narrowness of the recovery and the ongoing expansion is an issue. We think it'll broaden out. We'll see if it happens.
Right now, you're seeing the market price out or push back some of the expected rate cuts to July from June previously, in the sense that maybe this is not an economy that needs rate cuts. There are a number of people at the Federal Reserve who believe you should keep running this economy hot, because otherwise people could lose their jobs in the whole restructuring that takes place with artificial intelligence. And if you don't do that, you'll get scarring that lasts a long time. Where do you fall on that? Do you think that that's a legitimate argument, that you should proactively cut rates at a time of structural change?
I think they've done some of that. I think it's easy to see that they've done that over the last 2 years. The question is kind of where does that process end? I think the June-July period for the next rate cut is about right. And this data today says rate cuts, if and when they come, will be based on inflation. So when does the committee get evidence that inflation is decelerating, that tariffs are a transitory upward push on inflation? Sometime around the middle of the year is probably where that evidence comes through. But to your question, I think they have done some cutting preemptively to support the labor market and prevent some downside risk. We'll see ultimately if that was enough.
I noticed that was your focus coming into the new year, looking at the dual mandate, that you thought the inflation side of things, price stability, was going to be more instructive for the future of Fed policy. Is that right?
That's right. And this number, I think, confirms that, right? So they had to do some, they decided, the Fed, to do some risk management rate cuts to support downside or prevent downside risk to the labor market. They put in 75 basis points of cuts. The data suggests that things are stabilizing. So if and when the Fed cuts further, it will be, where inflation is coming out of the first quarter. We think it'll be about 3% year on year. We think it'll settle down to about 2.5% by the end of the year. Somewhere in there is room for a few more rate cuts.
The 2.5? We cut around 2.5 now?
No, well, we're thinking 3.
OK, all right. Michael Gapen of Morgan Stanley. Michael, thank you. Appreciate it. Thank you very much. So not quite Governor Myron-style rate cuts, but we're getting rate cuts.
You know who else thinks that we're going to get rate cuts and also thinks that we're going to get 3 rate cuts? Citigroup. And guess what? They nailed it. They got 135,000. We came in at 130,000. So they nailed it, and they still think we get 3 rate cuts this year. So it sort of speaks to exactly what Michael Gapen is talking about.
That's the moment we're in. A great divide on Wall Street at the moment that you can offer one bank 130 and they're like, yeah, great, and another bank 130 and they're like, yeah, the Fed's still going to be cutting 3 times.
Yeah, and ultimately it comes down to the evolution of inflation. So get ready for Friday, CPI Friday, because it is going to be an exciting one, considering that now this is a market that's focusing more on exactly how much room that gives the Fed.
So if you are just tuning in, welcome to the programme. A nice welcome, upside surprise on headline payrolls. That comes in at 130. The estimate was 65. The unemployment rate pulls back. That's the right kind of downside surprise. We're down to 4.3. The estimate was 4.4. And in the equity market, there's your outperformance on the Russell. It continues. The rotation gets some more oxygen. The Russell 2000 up by 0.8%. And notable at the front end of the yield curve, we reprice higher and push out rate cuts up by 7 basis points, the 2-year at 3.52. With an update on that and a whole lot more with your Bloomberg Brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. So, yeah, recapping all of that again. The major upside surprise for the labour market, non-farm payrolls for January coming in at 130,000. That's more than double the average analyst estimate. The annual benchmark figures were revised down, but close to expectations. The unemployment rate ticked down to 4.3%, and that was below estimates. More details emerging on the fight for Warner Brothers Discovery. Activist investor Ancora, which recently disclosed a $200 million interest in the media giant, strongly opposes the proposed merger with Netflix. The firm released a presentation urging Warner Brothers' board to engage with Paramount's offer, which last amounted to $30 per share in cash. The Super Bowl drew a TV audience of nearly 125 million viewers. NBC said that was a 2.2% decline from last year's record. Unlike last year, the big game competed for viewers with the Winter Olympics, which are also being broadcast by NBC Universal. And that is your Bloomberg Brief. John.
Vonnie, thank you. We're blaming the Winter Olympics for those numbers.
Of course.
Is that what that was?
That's ridiculous.
Really?
Honestly.
Come on. OK. Up next on the programme, Jim Bianco of Bianco Research. With bond yields jumping as payrolls blow past expectations, plus Chadha has your morning movers. Shopify gaining after a fourth quarter revenue beat. We should do payrolls Wednesday more often if we get numbers like this. An upside surprise, 130, the estimate 65k. Wages, hourly earnings a little bit hotter than expected, and the unemployment rate just a touch lower than anticipated. Equities up across the board and some outperformance on the Russell. We're up by 0.9% on the Russell 2000. In the bond market, yields higher at the front end. The 2-year yield up by 8 basis points. The 10-year bond yield up by 5 as we reprice Federal Reserve interest rate cuts and push them out by a month or so. As we count you down to the opening bell, 42 minutes away, let's get you some single names and morning movers. Chadha has more. Hey, Chadha.
Hi, John. After a rough week for Shopify, getting caught in the software sell-off, it is in the midst of a comeback. Shares have climbed for 3 straight sessions, getting a boost yesterday from MoffettNathanson upgrading the stock. And today, the shares are soaring up nearly 11% after it beat on revenue during the holiday quarter and gave a strong guide for the first quarter. Meanwhile, moving on to Mattel, not having the same luck. Shares are falling 30% in the pre-market after it posted a significant miss and issued weaker than expected guidance. The Barbie maker saying it expected holiday sales to surge, but that did not materialize, saying that consumers were hunting for deals and retailers managed their inventories very carefully. And we end on the semiconductor company Astera Labs. Shares are plunging 11% in the pre-market after revenue fell short of the more lofty estimates out there. Plus, some analysts are flagging that operating operating expenses were higher than expected, limiting the company's earnings beat. John?
Yahara, thank you. Thanks for the update as we count you down to the open and bound. The cash open just around the corner with equity futures on the S&P as session highs up by 0.5%. Let's keep it on the data. An upside surprise, 130,000 jobs added in the month of January. Traders now pushing out this year's first rate cut to July from June. Joining us now to discuss is Jim Bianco of Bianco Research. Jim, the obvious question I asked Mike Gapen, I'll ask you, Jim, is whether this is the real deal. How much confidence can you have in that jobs print?
Oh, I think you could have some confidence in the jobs print. I mean, I know there was a lot of revisions, and I know historically January and July are the most suspect months for seasonal adjustments. But that number was so strong in January that even if you were to give it a wider berth because of seasonal adjustments, it was still a good number. And I think that with the revisions, I think you can have a decent number on it. But, you know, the real question is, we average 15,000 jobs a month in 2025, but yet we still have 2.5 or 2.7% GDP growth for the year. That's what the estimate is. The stock market was up 17%. I think if you went back a year ago and you would have told us, you know, we're going to average 15,000 payroll jobs a month for 2025, we wouldn't have expected the stock market to do what it's doing, and we wouldn't have expected growth overall to be as strong as it was.
This is partly because this market believes what Kevin Hassett is saying, is that this is a supply side issue as much as it is a demand side one. And it's come from lower immigration and the fact that the population isn't growing. What do you make, though, of where wage growth fits into this, given the fact that we really haven't seen the commensurate wage growth that would signal that kind of labor market tightness that maybe some of these numbers might give hope for?
Yeah, and I mean, I'll underscore what you just said by pointing out that in the press conference 2 weeks ago, Jay Powell said that labor supply, how many jobs the U.S. economy need, is effectively halted, meaning I'm taking that to mean it's very close to zero. So if you're going to print, you know, 100,000+ jobs, well into 170 for private sector, I guess I'm not going to be surprised that we saw wage growth at 0.4%. Because if we are going to see 100,000 job months, we're going to see wage growth with that, too. We're going to see wage inflation with that. So I think it might be coming if we're going to see some big numbers like this.
So if you bleed this through the market, what is the trade? I mean, ultimately, if you do believe what market expectations are telling us, it's that in July, we're going to get a rate cut. If Citigroup is correct, we're going to get 3 rate cuts. It seems like Morgan Stanley is on the same page. Does that leave the 10-year in a perilous place? And does that leave cyclicals with a wind behind their backs?
On the second part, yes. I think that the broadening out of the stock market, cyclicals, that anything that's not AI related is a big winner in what we're seeing with the economic data right now. As far as the 10-year goes and the Fed, we've seen this movie before, that the market will perpetually price the next rate cut 4 months away. And in 4 months away, it'll be 4 months away, unless the data turns. If the data continues like we see, high 2s, maybe low 3s on inflation, and 2+ something, you know, in GDP growth, commensurate with all the data being consistent with that, which is what we have been seeing, we're not going to get to that rate cut. Now, maybe when we get a Kevin Warsh as Fed chairman, there'll be some political pressure on him to cut rates because the president has said he's going to sick his lawyers on him if he doesn't. But other than that, I don't think the data is going to basically support any rate cuts, at least for the near term.
We were told, Jim, that's part of a stand-up routine. That was just a joke. He wasn't serious. I've got no idea what the future holds. Jim, just to follow up, you've seen what Torsten Slok of Apollo's got to say. He thinks a rate hike is part of the conversation at year-end. It's a provocative piece. I'm sure you've read it. What did you make of it?
I mean, his argument, I think, is right. And I don't think we're that far away from it, because the assumption, if you listen to all your guests that come on, the assumption is everything will slow down by mid-year. Inflation will come down, the economy will slow. But if it doesn't, and it continues on the trajectory that we've been on for the last 3 or 4 or 5 months, and inflation stays sticky around 3%, I think it would be fair to start talking about rate hikes, because at that point, you could argue that the neutral funds rate is close to 4%. And currently we're at 3.5% right now.
Jim, it's good to hear from you, sir. Jim Bianco there of Bianco Research. Following the jobs data, the jobs numbers are really noisy, and they are subject to great revision, and we've seen that through the last couple of years, and you see it again this morning. If you want a decent anchor of where this labour market is at, not a perfect one, this is an imperfect one, but a decent anchor of where things are at, The unemployment rate's a decent way of doing it. That's why we started the programme, that's why we're going to finish the programme. That if you want a decent measure of slack, you can look to unemployment and or you could look to wages. And the fact that the unemployment rate has come down and continued to come down is an encouraging sign that even with jobs growth as muted as it has been, better today, but as muted as it has been, we haven't seen that slack continue to increase.
And not only that, but you also saw average hourly earnings increase or exceed the expected bump of 0.3% and actually come in at 0.4%. So all of this painting a pretty rosy picture. When you look under the hood of where the job growth came from,
healthcare.
It came from healthcare. I mean, I think that this is really interesting. Private education and healthcare services, 137,000 jobs created. Where didn't it come from? Government. 42,000 jobs taken out there. And guess where else? Financial activities. That trimming around the edges, down 22,000 jobs in the financial activities areas. So it's a really interesting picture where the job creation is really shifting around.
Want to see more of it? Goes against the grain just a bit, given the data we've seen recently. Certainly want to see a lot more of this. I think if you go to the next Fed meeting, though, and unemployment is falling and not climbing, it's difficult to make the case to reduce interest rates anytime soon.
That's why July gets a lot more interesting, and that's why the Wurster Fed gets a lot more interesting, especially if the market doesn't see the data to justify rate cuts, but you do have the legal threat, maybe, threat overhanging over the Fed chair to potentially go forth with a rate cut regardless of the economic
better
data.
on a Wednesday, because we can talk about it on Thursday and Friday, and
it sets up CPI.
The story doesn't die into the weekend.
I think this is actually really good.
This is good.
I think
it's a trial run. We should do it more often.
I was going to say the same thing. It was a successful trial run.
Coming up tomorrow, Congressman French Hill, Kristen Bidley of Citi, Megan Graper of Barclays, and Matt Lazzetti of Deutsche Bank from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.